This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Why are we upset if we're creating jobs?
Inflation's still a thing out there for the everyday consumer.
With Lisa Mateo on markets.
The economic calendar jam-packed today.
And Michael Barr with news. Tensions between the U.S. and China have heated up even more. The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast. Tom Keene, he's off today. That happens every once in a while, but not to worry. Alix Steel joins us for the next 3 hours. How good is that, Alex? Get up a little earlier?
Oh,
How
yeah.
fun is that?
I mean, I have to say, I was a little surprised that Tom Keene didn't want to come in when we have this kind of day and this kind of open and the kind of slide that we had on Friday. But I'm not one to judge.
It's interesting. I left the studio Thursday. I wasn't on the air Friday. Thursday, all we were talking about was soft landing. Boy, the Fed's done a nice job kind of negotiating. Man, that changed on our Friday.
It was a huge narrative change over the last 72 hours in the market.
So we're going to try to get caught up here. The tape is looking very red on the screen, as Nathan has been reporting all morning. We're going to kick it off strong. Quincy Krosby, Chief Global Strategist at LPL Financial, is going to join us just to kick this thing off and get a sense of where this market's going. Lori Calvasina, she's one of our favorite market voices, RBC Capital Markets. She's going to join us here in the next hour or so. We'll get a sense of where she thinks this market is going to go. So we've got a lot of market voices, a lot of economic voices here this morning. Try to put that jobs data in perspective, the market reaction in perspective. We're going to do that over the next 3 hours here on Bloomberg Surveillance. But right now, let's get just a snapshot of what's happening out there with Lisa Mateo for the Bloomberg Business Flash.
You got it. And a lot going on. The global stock sell-off deepens. European stocks set for their biggest three-day decline in 2 years. Right now, we have the Stoxx 600, the DAX in Germany, both down more than 2.5%. The CAC in Paris and the FTSE in London both down more than 2%. We head over to Japan. We have the Nikkei down 12%. The yen right now up more than 2% at 142.54 against the dollar. The NASDAQ 100 set for its biggest opening drop more than 4 years. And this is after entering into a technical correction on Friday. Right now, NASDAQ futures down more than 4%, 785 points. We have Dow futures down more than 1%, 734 points. S&P futures down 2%, 147 points. Let's get to the big names having an impact on those tech stocks. We have NVIDIA down more than 9%. Reports that its highly anticipated Blackwell chips will be delayed due to design flaws. Then you have Microsoft falling 4%, Meta, Alphabet, Amazon down more than 5%, Tesla even plunging 7%. Apple shares, they're really taking a hit too. We had the news that Berkshire Hathaway slashed its stake in the company by almost 50%. So we have Apple down more than 7%. Finally, we'll head over to the bond market. The 2-year yield, 3.75%. That's down 12 basis points. And we have the 10-year yield at 3.74%, and that's down 4 basis points. That is your Bloomberg Business Flash. Paul and Alex.
Lisa, my head is spinning with all those numbers. I mean, I don't know where to start, Alex. I mean, you take a look at the yen at 142. We were just at 160.
Yeah.
Like a few weeks ago. It's just amazing. And then you've got the yen opening. It's down 12.4%. Some of these moves in some of these indexes around the world are just stunning. I
mean, it's hard to not overstate the carry trade impact. I mean, even simple as like, I'm going to borrow some money in yen, and then I'm going to go buy tech stocks.
Right.
Oh, that doesn't work anymore? I got to sell those tech stocks and cover that position. I mean, are we just in something that basic, which means if it's not actually necessarily broadly fundamental, and we'll talk to Lori Calvasina about this, her notes like, look, the earnings picture has not been that different from the last quarter.
Exactly. And how about on the yield curve? I mean, we were talking, we've had an inverted yield curve for the longest time, more than 100 basis points there a couple of years ago. Now we're basically at parity here. The 2 years at 3.76%, the 10 years at 3.75%.
Now that move is tremendous.
Yes.
And the speed with which we re-rated in that bull steepener, tremendous. And that knock-on effect, I wonder what we see from that.
If I see Lisa Bronwitz walk past the studio, I'm going to bring
She's
her in
off
here.
This week.
She is?
Yes.
When the yield curve finally, disinverts or whatever,
she
takes
missed
the week
Friday
off.
and she missed this week.
Oh, my goodness, Lisa. All right, let's go to a pro here. Quincy Krosby, Chief Global Strategist at LPL Financial. Quincy, thank you so much for joining us here. What do you make of what transpired from the close on Thursday to where we are here?
Well, you could attribute it to the unemployment number. jumping. It skipped 4.2, went right to 4.3. Expectations were that it would remain at 4.1. And there have been concerns. Even Powell mentioned it at the press conference that they are, I don't know if he used the word monitoring, but it was close to that, the employment landscape. He has been invoking the maximum employment mandate over and over again over the last, month or 2 months. And now he's got a situation in which the market believes that the push in the unemployment rate, which in and of itself isn't, but he even talked about 4.1, was still a resilient labor market. Well, we jump up to 4.3. The question is this the harbinger of a labor market that is going to weaken at a faster clip? Because that's what the historical pattern suggests, that once you start moving up higher, it continues to move up higher. The other thing were the initial unemployment claims and also the continuing claims. And that is worrisome because you can argue about the participation rate, all of that. But when you see that people cannot get jobs, it's harder and harder for them to get jobs. You have to look at this employment landscape and wonder, is there something deeper going on? And you don't have to be a PhD economist to figure it out. Yes, there is. Companies may not be linked right. So therefore, you had that. And that was, by the way, in conjunction with the ISM manufacturing report that has been deteriorating even at a faster clip. Today, we'll have a bigger picture on the services.
Yeah, we get those ISM services at 10 o'clock, which I love that indicator as well. It didn't take Wall Street banks a lot to jump on this. I mean, within hours, we got JP Morgan, we have Citi looking at 50 basis point cuts for September and November, and then 25 basis point cut in December. Other banks sort of added on to that. Are those kind of calls justified?
They'll only be justified if the numbers continue to deteriorate. The market has wanted, as you know, what was it, 7 rate cuts this year? They're lucky. And then they thought, maybe we'll get one in September. But the fact of the matter is that finally they have an economic rationale for suggesting that the Fed has got to come in and offer more help. And the Fed is going to have to do it. The worry is, and I don't mean to be looking at what they did wrong at the beginning. They waited too long to raise rates, and then they are looking as if they're behind the curve already.
Emergency rate cuts, put that into context. When do they happen? Why do they happen? Should emergency rate cut be on the table?
Well, it should always be on the table, and it is always on the table because the Fed could come in at any time to raise rates or cut rates. And I think if they do see that the unemployment rate is going to rise again, if we start to see a host of data releases that suggest even more deterioration, such as what we're going to have this morning with the ISM service sector report, they may have to do that. They don't want to do that. There's always this suggestion. Now, this is what's ironic, that it'll scare the market. Well, take a look at the market today. Take a look at it on Friday. The market is already scared. They're not going to cave unless they really believe that they are behind the curve. And the other thing is there are rumors that at the last Fed meeting, there were those who suggested that they needed to cut rates at that meeting. The Fed is waiting an awfully long time until September 18th. The market is clearly not waiting that long.
So that brings the question into the actual market action. If you look at the S&P futures, we're down by 3%. NASDAQ futures off by over 4%. I mean, it's ugly, right? And this raises the question of selling begets selling. Like, once you trigger stops, then you have to sell more. You have a systemic funds that'll come in at 9:30 when the cash market opens, and they're going to have to be selling more, like CTAs. You have the yen carry trade unwinding. How much of that is playing in versus the fundamentals?
Well, this is the basic argument, because you can make an argument on both sides of the equation right now. The labor market, with the numbers that we have, suggests that there is still some resilience. The fact that the GDP report for the second quarter, the first read, came in at 2.8%. The fact that consumers continue to spend. But the question is, the market is looking ahead. That's the market's job. And by the way, I should point out that the economists at the Fed should also be looking ahead, because that's an economist's job as well. And then the concern is that, again, selling begets selling, buying begets buying. That's the way it is. Margin calls are coming in. It creates a vortex of the VIX climbing higher. We haven't seen the VIX climb this higher in a long time. But the fact of the matter is the Fed is going to be very careful about coming in and suggesting that we need an emergency move. However, I do want to point this out. I will never forget Christmas Eve on 2018, as that market just tanked, and the Fed, that December meeting, raised rates, suggested we would have rate hikes in 2019. The first Friday in January, the Fed called it off. Remember that before the market opened, right? Fed's going to be patient. End of story.
All right, Quincy, fantastic perspective. Thank you so much for joining us. Quincy Krosby, she's the Chief Global Strategist for LPL Financial. With our news in New York City, Mr. John Tucker.
All right, Alex and Paul. Hurricane Debbie has made landfall in Florida's Big Bend region, where residents have fled ahead of a potential week-long disaster across the south. Bloomberg meteorologist Rob Carolyn, he is tracking the storm.
Now, the very big concern with Debbie is as it moves inland over North Florida over the next day or so, the steering currents are going to collapse, and that means there's going to be nothing pushing the storm along. So it's just going to kind of meander over portions of southeastern Georgia, maybe eventually off the coast of southeastern South Carolina. This means some very heavy localized rains are going to fall over North Florida, eastern Georgia, and South Carolina through the first part of the work week.
Top winds intensified to 80 miles per hour, making Debbie a Category 1 storm. Israel bracing for possible attacks from Iran and regional militias after high-profile assassinations of Hamas and Hezbollah leaders this week. Prime Minister Netanyahu says his country is in a multi-front war. But the White House urging Netanyahu to redouble ceasefire negotiations with Hamas, even as the U.S. moves in a fighter jet squadron and keeps an aircraft carrier in the area. Here's Deputy National Security Advisor Jonathan Feiner.
What we're trying to do is prepare for any eventuality, any possibility. That's only responsible for the United States. Obviously, we've been quite clear that we'll work with our ally Israel to defend itself against any threats that it faces, and we are in a moment that appears to be of heightened threat.
Well, the White House focuses on geopolitical tensions. Vice President Harris is reportedly in the final stretch of choosing a running mate in her campaign. She met Sunday with at least 3 possible running mates. And after 10 days in theaters, Deadpool, Wolverine, already the highest-grossing R-rated movie ever. In the second weekend, the Marvel Studios blockbuster starring Ryan Reynolds and Hugh Jackman continued to steamroll through movie theaters over the weekend, collecting $97 million, according to studio estimates. And some of that money came from me.
You saw it?
Yes.
You did not. Wait, but did you see the first one?
Dragged, kicking, and screaming to the local theater to watch this movie.
And?
I didn't get it. I mean, some of the lines were funny, and I didn't get it.
Do you feel like you'd get it if you watched the first 2?
That's never going to happen.
Okay.
I'll go wait for the book to come out.
Well, it's already out. It's called a comic book.
Oh, comics.
That was made, but that's fine. But
yeah.
Okay.
But John, you know that Alex is like the mega fan of the whole Deadpool thing.
Which is fine. I respect that. I just don't get it.
All right, John Tucker, thank you so much. All I know is this is money in Disney's bank. It means the movie business is not dead.
You need to see it because there's all this really great Fox-Disney merger stuff.
All right,
You'd love
I'll get into it. All right, very good, John Tucker. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by BAM Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Be part of building America. Invest in BAM insured bonds. All right, a lot of red on the screen. Concerns about a U.S. economic slowdown kind of intensified. Traders ramping up those bets that the Fed will step in with an emergency interest rate cut. Now, economists at Goldman Sachs increased the probability of a U.S. recession in the next year to 25% from 15%, but added that there are reasons not to fear a slump. Let's get to futures right now. NASDAQ futures down more than 4%. Dow futures down nearly 2%. S&P futures down more than 2.5%. Bitcoin also taking a hit. It was down as much as 16%. Now Bitcoin down more than 12% at 51,796. Cryptocurrency linked companies taking a hit. We have Coinbase Global, Marathon Digital down more than 14%. MicroStrategy falling about 17%. To the bond market, we have the 2-year yield at 3.75%, down 12 basis points. The yield on the 10-year 3.74%, and that's down 4 basis points. On the economic calendar for today, we get a look at the service sector. We have a report on from the Institute for Supply Management. Tomorrow, it's on to U.S. trade. Wednesday, consumer credit, and then the weekly report on initial jobless claims out Thursday. And the rush for quarterly earnings continues. This week, we'll hear from companies that include Disney, CVS Health, Uber, Novo Nordisk, and Yum Brands. That is your Bloomberg Business Flash. Paul and Alex.
Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast. Summer Games Updates. I'm all into the Summer Games. They're brought to you today by State Street Global Advisors. How about that? All right, fixed income. Interest rates go up, bond prices go down. That's all I need to know, right?
Maybe. I don't know, but sometimes they tell us stuff.
They're boring. People in fixed income are boring. I mean, they're all negative. They think like the world's coming to an end.
This is true.
You know, I'm an equity guy. I'm an optimist.
You have to be positive. You're an M&A guy. You gotta
exactly.
Be positive.
George Contrabone joins us here. He's head of fixed income for the Americas and Trading at DWS Group. That's serious, folks, in the fixed income business. George, I mean, let's just go with this yield curve thing that Lisa Bronwyn says I have to pay attention to. The 2 years at 3.75%, the 10 years at 3.74%. We basically, that inverted yield curve is done.
Yeah.
Does that mean anything to you guys?
Of course. And I feel like with all the scaffolding around New York City, it was like 500 some odd days without an actual accident of that yield curve being inverted.
Right.
But what I'd say to investors is it's not actually the inversion when the recession starts, it's actually the re-steepening when that recession actually starts. So look, everyone is talking on recession watch, and I think this, you're seeing now front-end yields come down, being bought in anticipation of the Fed actually cutting rates and seeing a re-steepening of the curve.
Yes, and the speed at which it's happened, though, tremendous.
Terminal velocity.
On Thursday, it was 23 basis points inverted, which felt reasonable. And then in 24 hours, this is what basically happened. What does that do if you're a fixed income guy?
I think, certainly part of that's been missed, and this is geopolitical. We started seeing this move happen last week. You saw a little bit of a rotation going on as well. You saw overseas buyers stepping in and really kind of started the ball rolling going into that actual NFP number. And then when that happened, just straight down and causing an entire repricing of the yield curve in the bond market itself.
So we saw the jobs. Again, I wasn't in here Friday. I was down on the beach, as I should be on Fridays in the summer.
Understood.
Person like me. We left Thursday. Boy, everybody was talking about a soft landing. The Fed had done such a great job. But boy, that narrative seemed to change on Friday coming into this pre-market trading today. What did you guys make of it on your desk?
I think to Alex's point, it spoke to the positioning or complacency. I heard your Olympic update. Maybe people are staring at our medal count or on vacation as well. And that's what happens when yield curves uninvert. It happens incredibly quickly. So, I mean, it feels like a little bit of an overreaction, to be honest with you. One thing that we're still trying to go through and what the BLS didn't speak to was the 436,000 workers, non-ag workers that were trying to get to work that couldn't because of weather. We're also coming from a really low base as well. So I appreciate the SOM rule coming into effect over a 3-month period. I would also say during that same 3-month period, we averaged 170,000 ads as well. So again, with the VIX at 50, this certainly feels capitulatory. It feels like people are on the wrong side of this trade and playing catch up this morning.
You mentioned the VIX. I'm going to call out the VIX in honor of Tom Keene. I was remiss here today. You're right. The VIX is up 26 points. I've never seen that. Maybe back in 2000, back in the day, the pandemic. It's now at 49.7. So for Tom Keene to take today off when his beloved VIX gets back to 50.
I'm telling you, I really thought I was going to get a call being like, hey, you don't have to come in. Tom's going to come in.
Right.
But not even that, but the VIX inversion that we saw on Friday was massive. Like the way that curve just flipped within a week was tremendous. Here's my question, though.
Sure.
If we are worried about growth, why isn't the back end selling off?
Yeah, look, it's a great question, and I think you may, in fact, see that. I think there's a lot of questions. You saw this coming up with respect to the election, with respect to supply, and that steeping, and I think that will eventually follow, actually. So I would look for long-end yields, 10 and out, to start to push. But look, there's also been a look for duration, and companies trying to both issue, but long only is looking to extend duration coming into this, and obviously in flight to quality, extend out. There's a little bit of FOMO that you're seeing right now as well. So we're in the early stages of this, and you're seeing a duration grab at the moment.
What do you think this Federal Reserve is going to do over the coming weeks here? I mean, did they wait to September? Did they? I don't know. Some people have been talking about kind of an emergency cut here. What do you think is going to happen?
60% chance at this point, right, of going early. I struggle with that, and they don't think they want to incite panic. And I think Goolsby bringing out a noted dove fairly early and saying, well, okay, and getting a little hawkish, just saying, let's be patient. We're looking at data, not data points, and slowing things down should help. Now, you're going to obviously get ISMs, you're going to get jobless claims, and you're going to get a ton more Fed speakers this week. I would not expect them to come in at this point in time for fear that you're going to make things potentially worse right now.
Well, that's the problem, too, is that you look at WIRP, the WIRP function on the terminal, world interest rate probability, and that shows 125 basis points now of cuts for this year. And that's added on to, like, JP Morgan, for example, all predicting, and Citi predicting a 50 basis point cut in September as well. If the Fed is to come back and verbally walk that back, then what happens to the bond market?
Sure, and what happened just in the beginning of this year when we were talking about 5 or 6 cuts as well, right? So now it turns out we may get that, but our own call is 25, 25, 25. I think 50 would be way too premature. I would actually expect, once that happens, to your point, to see that front end come up a little bit and things to stabilize. So we've moved, for the bond market, we've moved significantly in a short amount of time, and this seems to be overdone, and I would expect yields to come back up again in the interim once things start to settle down. But at the moment, in the absence of additional data besides ISMs and jobless claims, expect more of this volatility and some follow through here.
So what are you guys doing on your desk these days?
Well, trying to manage this volatility. We're in a different regime now, right? This is a very different bond market from when the VIX was at 12 and 10-year was at, call it 450 or something like that. You've completely switched, to your point. So I expect that calendar to get bought. I expect concessions to finally go up from near zero to single digits. I expect a continued focus on high quality. And keep an eye on some of those triple Cs, double Cs, and some of those companies that were struggling coming in. I think this is when times get really difficult.
Wait, so finally there may be a shakeout in the corporate bond market?
This is the boy that cried wolf recession, right? This has been 2.5 years of this, and it feels as if we are finally here. But look, let's also be cognizant of recession. It doesn't mean GFC. It doesn't mean the entire death knell of the market. You can have rolling recessions, light recessions, shallow recessions. So you may see some of that. So I don't know if you're going to see 12% defaults. But
so I mean, again, the 2-year Treasury 3.75%. It's off 13 basis points today. Kind of feels like the market's telling you this Fed's maybe. I mean, it's telling you the Fed's behind the curve. I guess it's changed.
It certainly feels a little bit like they're behind the curve right now. I think Powell wishes he had that NFP in advance.
Yeah, exactly. George Contrabone, thank you so much for joining us. Head of Fixed Income Americas and Trading for DWS Group, joining us here in our Bloomberg Interactive Broker Studio. We appreciate that. I'm going to call this out for Matt Miller. Bitcoin off 12.8% today, off $7,500, 51,600 for your cryptocurrency there. Just another one of those numbers like the VIX, just under 50, up 26 points on the VIX. That gets your attention just from a volatility measurement perspective about what the market's discounting out there. S&P 500 off 2.8%. NASDAQ off, the futures off 4.3% again here. WTI crude oil off 1.6%, $72.30 per barrel there. We're going to have more coming up on these markets. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Global stock markets tumbling, tech shares really taking a hit. NVIDIA, one of the biggest decliners this morning, now down more than 10%. And this is after reports that design flaws could delay its latest generation of AI chips. Microsoft, we have falling more than 3%. Meta, Alphabet, Amazon down more than 5%. Tesla plunging 8%. Apple down more than 6%. Berkshire Hathaway slashed its stake in the company by almost 50%. We have NASDAQ futures down more than 4.5%. Dow futures down 2%. S&P futures down 3%. To the bond market, the 2-year yield 3.73%, down 14 basis points. The 10-year yield 3.73%, and that's down about 6 basis points. To commodities, we have spot gold lower at $2,396 an ounce. We have Brent crude $75 a barrel. WTI crude $72 a barrel. Few companies making news. CrowdStrike. They said Delta CEO actually ignored an offer for assistance in the wake of last month's huge IT outage led to thousands of canceled flights. Also a federal investigation of the carrier. CrowdStrike down 6%. We have Delta down 4%. And it could be one of the biggest deals in consumer industry this year. Sources say candy maker Mars considering buying snack maker Kellanova. And that deal would give Mars brands like Pringles, Cheez-Its, and Pop-Tarts. Kellanova up 16%. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa, I got through 2 years of business school at Duke on 2 food basic groups.
Oh, boy.
One is pizza, and the other is Pop-Tarts.
Oh, Pop-Tarts.
Yes. Start off the day with Pop-Tarts, end with
no.
pizza, throwing some beer at the end. That was it for 2 years at Duke.
I mean, but you're like in your 20s, right?
Yes.
So, I mean,
Yeah.
fair enough.
Fair enough.
You couldn't do it now.
I didn't eat so well in my 20s either. But,
Exactly.
Pop-Tarts, I look at them and I feel ill.
Exactly.
Sorry.
All right, Lisa
Editorializing.
Mateo, thank you so much. Alix Steel, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Boy, the world has changed in the last several days. How are some of these professionals kind of rethinking kind of where we go from here? Sarah Hunt joins us. She's a partner and chief market strategist at Alpine Saxon Wood. She joins us here in our Bloomberg Interactive Broker Studio. She should probably be back at her office talking to clients and all that kind of stuff, but she agreed to be on our show like a couple of weeks ago when the world was kind of normal. Now things have changed. Sarah, what happened from the close on Thursday to where we are today?
Well, I think you have a couple of things that happened. First of all, the market really wanted to go up at the beginning of the year. It went straight up through July pretty much without too much of any hiccups, a couple of small ones, but not a lot. And then you had the data start to really turn around. And I think that the ISM number started it. And I think that that manufacturing data was not just weaker than expected, not just sub 50, but something like 46. And I think that that was at the beginning. The jobs number cemented it. And I think that you also have a lot of global tensions that are happening, and you have a lot of levered trades in the market that are starting to unwind. The BOJ didn't help, and I think that had the Fed cut last week, you probably would have had less of an amplitude of problems, but the direction would still have been down.
Funnily enough, some are saying that if the Fed does an emergency cut, that's going to exacerbate the yen carry trade unwind, which is going to make things even worse, say, for the equity market. Sarah, what do I do today?
I think today is a lot of watching. I think that today is one of those days where you have to see, okay, do we settle in here someplace, or does this just continue to be a problem? And again, I think a lot of this is technical, and I would agree that the concern of the Fed doing an emergency cut or stepping in too hard is now going to then worry people even further in a way that that isn't necessarily going to be helpful. These markets now need to stabilize, but again, you have a lot of very levered trades. You have a lot of carry trades on the yen that were sell yen by technology. You're unwinding some of that. It's hard to understand when those technical trades stop, and I think that that's part of the issue, and maybe some better data on ISM services can help, but I don't think it solves the issue, because right now it's no longer about the fundamentals. It started with fundamentals and then it started to unwind.
I mean, the futures continue to deteriorate here with the S&P off 3.2%, the NASDAQ off 4.7% here. So it feels like a little bit of a kind of a frenzied mood in the market here today in terms of some of the selling pressure here, which begs the question, if you're the Federal Reserve, what do you do?
Well, I guess, again, this becomes a question of, am I going to have a Fed put that jumps in immediately just because the market is down 5 or 6% in a couple of days?
Yep.
Now, that's a big move, and we've seen some big moves before, and they have ended up being worse, but I would argue that the underneath fundamentals are not as bad as you saw in some of the other issues. In 2000, you had 2001 you had different issues, in 2007 you had different issues. So I don't think that this is the same, but I do think that this is an exacerbation, and it's August, so trading is thin, and you always get the pendulum swinging too far. So the question becomes, is the underlying that bad? I don't think the underlying is as bad, but I think we need to settle a little bit before people can start to appreciate that. And we finally got the slowdown that everybody was looking for, but all of a sudden it became a shock that we were slowing down.
Okay, so we wait a little bit till things calm down, but what's on my shopping list?
I think on your shopping list, a lot of the technology that people were afraid to buy because the valuations were so high, all of a sudden starts to look more attractive.
Is this just like Mag 7 kind of thing?
It's Mag 7, but it's also the related, a lot of the companies that are related to that infrastructure, because I think that we are going to continue to see that infrastructure build, and I think that the companies that can afford to pay for it are the large mega cap hyperscalers, and they're going to keep paying for that. They're going to keep putting that capacity in, regardless of whether or not someone like Elliott thinks that it's overhyped, because we still don't know exactly what's going to happen with the AI trade and where things are going to go, but we know that people want that capacity, so they're going to keep building that. And there's real earnings still. It's not like earnings have collapsed. They just weren't as fantastic as they had been in the first quarter. And I think that that's also just added to the problems that we're seeing right now.
So, I mean, I was off on Friday, as is wont to happen in the summer. Thursday, leaving the studio here midday, everything was fine. Soft landing, giving the Fed a pat on the back. Boy, September seems like a fine time to cut rates. But did things really change because the jobless claims came in a little bit light?
So again, I think that it's one of those things where it is the totality of the problems as opposed to the economic data. There were a lot of things that were swirling around. You also have to look at the international situation that is going on, where people are worried about retaliation now between Iran and Israel. That also can be very destabilizing, because there's a large, obviously, energy component to that part of the world. So people start to worry about that. They start to worry about all the things that they were managing not to worry about for the first 7 months of this year. And then you layer in some bad data, and you layer in the Bank of Japan raising rates when everyone thinks that the Fed should be cutting rates, and the yen carry trade unwinds. And then all of a sudden, what was a small problem becomes a much bigger problem. And I think that again, you had a lot of buildup of people with pressure, selling pressure that was coming in that people didn't really expect. And I think we're hitting an air pocket here, and it's August, and let's hope that this stabilizes. Yeah. But the backdrop isn't terrible. The valuations were probably too stretched for what was a slowdown in the economic picture.
So then if you have the traditional sort of Mag 7s and the other stock market winners sort of on your shopping list, what about in the meantime? Is it about dividend players? Is it real estate? Is it utilities? Like, is that a place to hide out?
Well, we have already, we have a couple of strategies where we're looking for companies that are capital return companies that are paying dividends and buying their stock back. We're not just in technology. So for us, this is an area where some of those stocks start to look better because those valuations did not get as stretched. But when the market comes down like this, it comes down almost indiscriminately, because right now what you have is an unwind which forces selling that people don't necessarily want to do. But we think that what will end up benefiting is a lot of the companies, to your point, that are in different areas and that the valuations were not as stretched. That's companies that have dividends, but that's also companies that are generating enough cash to buy back their shares. So you really, like we've been talking all year about looking at balance sheets, you really need to understand where people's balance sheets are now, because rates have not come down, but you really better be generating cash if you want to do better in an environment where all of a sudden people are starting to really worry.
So what's your underlying view at the folks at Alpine Saxon Woods about this economy? What do you think? I mean, how is this economy these days? It seems to be growing. Inflation seems to be moderating, but maybe some of the underlying drivers are maybe weaker than expected.
I think part of the problem is we still haven't normalized, quote unquote, coming out of the pandemic. You have a bifurcated economy where the top end of it has been doing better than the underneath. The inflation has been terrible for people under certain income levels. Yep. And I think that the jobs picture, when people were trying to keep talent, probably left too many people keeping, and so then you're going to have more layoffs. So the question is, do we get into a recessionary environment, even with GDP looking okay right now? It feels like a recession for some people already. So what happens to everything else? And I think that's harder to parse, but the earnings are not falling off a cliff. It's not like that's a terrible situation for corporate America. It's just very difficult to understand right now where we're going, but we're definitely slowing down. And that was something that people expected to see when the Fed first hiked rates, and then it didn't happen, and it didn't happen. So there was a complacency that slowdown might not have to come, and that was the whole soft landing. And we just did a U-turn on that, and now we are, oh my goodness, what's going to happen now? Yep. But I think that there's a cumulative effect there.
Because my question is, on a broader sense, again, like what really changed from earnings from the last quarter to this quarter? And also, if you still have the hyperscalers spending bazillions of dollars, how can we have a true recession? Like, that's going to support GDP in some capacity, right? Like, I have a hard time reconciling those two things.
Well, that's what I mean about a dual track economy, right? Because some parts
it's like K-shape in a big way.
Some parts of it are in recession and some parts are not. And that's part of the issue, I think, with the ISM numbers is that manufacturing continues to stay weak and people were worried about that. We'll see what happens with the ISM numbers, but I think that this is part of the issue on what's going to happen going forward. You're still seeing reasonable earnings out of some sectors, but other sectors, look at some of the consumer discretionary. They did not have good things to say because people are pulling back on spending. And you are starting to see that because there is a real issue with people's budgetary problems and the fact that price levels are not coming down. Inflation may be moderating, but price levels are high, and that's very difficult for most households.
Yep, it certainly is. All right, Sarah Hunt, thank you so much. We appreciate that. Sarah Hunt, she's a partner and chief market strategist at Alpine Sachs & Wood. So let's look at some of this pre-market trading here. Just to give you up to date. S&P 500 futures off 3.1%. The Dow off 2.1%. That's 842 points for those at home. 4.6% pullback on the NASDAQ futures. 855-point pullback. 17,700 for the NASDAQ. On the yield front, two-year Treasury off 15 basis points. 3.72%. Right in line with the 10-year Treasury. That's at 3.72%. So those kind of levels get your attention. With our news in New York City, here's Mr. John Tucker.
All right, Paul and Alex, the National Weather Service's Hurricane Debbie has made landfall in Florida. Now, Bloomberg meteorologist Rob Carolyn says rain totals could reach a foot or more.
Debbie will make landfall later this morning over the Big Bend area of Florida, then move north-northeast across portions of northern Florida. It is going to bring high winds and also some very heavy rain to northeastern portions of the Big Bend area, also over northeastern Florida and southern Georgia. And then later this week, heavy rains will move into the Carolinas. John?
All right, thanks, Rob. Communities near Savannah could see up to 20 inches of rain and as high as 30 inches in isolated areas. Israel bracing for retaliation after the assassination of top Hezbollah and Hamas officials. Axios reports Secretary of State Antony Blinken told G7 counterparts an attack by Iran and Hezbollah could start in 24 hours. Vice President Kamala Harris reportedly in the final stretch of choosing her running mate. That story from Bloomberg's Ed Baxter.
3 people on her short list met with her over the weekend: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Kentucky Governor Andy Beshear, Transportation Secretary Pete Buttigieg, and Illinois Governor J.B. Pritzker also are names that are still being floated. Now, the Democratic Party is planning to virtually nominate a ticket by August 7th, and Harris has said that she plans to hit the campaign trail with her running mate tomorrow. Ed Baxter, Bloomberg Radio.
And Pope Francis accepted the resignation of Cardinal Sean O'Malley as Archbishop of Boston and has named the current Bishop of Providence, Rhode Island, Richard Henning, to replace him as leader of one of the most important Catholic archdioceses in the U.S. The announcement from the Vatican didn't mention O'Malley's other main role as Francis's main advisor on fighting clergy sexual abuse. And the update from the Olympics: no medal, sorry to say, for Simone Biles on the balance beam this time. The American gymnastics star slipped and fell at the end of her acrobatic series on the aerobic series on the beam finals.
Aerial series.
It says
aerial.
No, acrobatic
it's
series.
Aerial. She's doing stuff with no hands.
Okay, whatever. Anyway, she fell, so that denies her an opportunity to add to the bronzes she won on the event in the 2016 and 2020 games. You know, it is just so difficult to read over here. It's just like...
He's behind the pole.
We exiled him.
Pole. Anyway.
John Tucker on
Global News, 24 hours a day, whatever you want it with Bloomberg News Now. I'm John Tucker. This is Bloomberg.
All right, John, thank you so much. We appreciate that. The balance beam is crazy hard.
Oh my God, that's 4 inches. Who created that thing?
I don't know. I mean, it's just watching on TV. How did they? I couldn't walk from one end to the other, much not do all these jumps they do. But anyway, Simone, she fell. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Global stock markets really taking a hit. We'll start with the Stock 600 in Germany down nearly 3%. The DAX in Germany down 3%. We have the CAC in Paris and the FTSE in London both down more than 2%. Over to the Nikkei right now down more than 12%. To currencies, we have the dollar weaker. Japanese yen up more than 2.5% at 142.76 against the dollar. Let's get to that tech sell-off. Leading the charge, Nvidia down 11%. Then you have chip makers, including Intel, Advanced Micro Devices, also plunging. We have Intel down about 5%. You have Apple down 7%. Berkshire Hathaway slashed its stake in the company by almost 50%. It was part of this massive second quarter selling spree. Tesla shares also lower. To the bond market, the 2-year yield 3.74%, down 13 basis points. The yield on the 10-year 3.73%, and that's down 6 basis points. We have spot gold lower, 2,383 an ounce. Brent crude $75 a barrel. WTI crude $71 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. Bloomberg Surveillance today is brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. I'm blaming this whole thing on Michael McKee. I left Thursday. Things were fine. Friday, I'm on the beach, relaxing, having fun. Jobs numbers, they come in weaker. The whole market narrative changes. Michael McKee, how bad was Friday? I mean, I missed all your commentary because I had no interest.
It was brilliant, obviously.
Yeah, absolutely brilliant.
The waves were great on Friday, so I was in the water the whole day. What happened Friday that I missed?
Well, we got weaker than expected job creation and just enough added unemployment to trigger the SOM rule if you go to 2 decimal places. And I had the opportunity to ask Claudia, and she says do 2, not 3.
It's her rule.
So if you do 3, you don't get the SOM rule. If you do 2, you do. But then she also pointed out that it's not necessarily going to be a sign we're in recession because unemployment was extremely low. We've had increasing labor force, and that may be the reason. It's not that companies are firing a lot of people, which has been the case for the SOM rule in the past. And the markets have been looking for a slowdown, and there has been fear that we were going to see some sort of contraction coming up. And then the Fed did not move last week, and we got a worse than expected jobs report, not a terrible jobs report, but worse than expected. And so the markets put 2 and 2 together and got 2. And basically started panicking. Now, I don't blame me because I'm here. I'm doing my job. It's Keene who didn't show up today.
Yeah.
So
he's so traumatized
obviously
by the
there's a sign of guilt there.
Yeah. Well, here's my thing, is that you also talked to Austin Goolsbee later on that day, and he's more on the dovish side. So he had a chance to sort of really talk up a rate cut, and he really didn't do that. What does that tell you?
The Fed is fairly sanguine at this point about the course of the economy. They do think they need to lower interest rates, but they're going into the jobs report. Their view was it would be because you were normalizing rates and the rates were too high for the current economic conditions. Now the markets are trying to tell them the story is that the Fed needs to do emergency cuts because the economy is going to go into recession. One labor market report that isn't particularly good and ISM manufacturing that wasn't particularly good have really scared the pants off people. But there's a long time between now and Jackson Hole and between now and the next meeting.
Interesting. Maybe I should pack my bags for that. We're going to get some more economic data today. Michael, what are you looking for here? We got some the PMIs, services PMIs, composite, ISM data coming out here today. How geared up is the market for some of this data?
Oh, they're going to be on the edge of their seats for the ISM services data. If the ISM services data come in badly, we'll start with the plot twist everybody wants, like the train wreck. If it comes in a second month of contraction, then you'll see people really, the panic will be fed. If it comes in above 50, as is forecast, then we're likely to see maybe a little flattening out of the fear.
I mean, it's just me confirmation bias, really, right?
Yeah.
ISM services at the end of the day.
Exactly. And service is the biggest part of the economy, and we got the bad manufacturing numbers. But interestingly enough, in the ISM manufacturing, the employment index fell sharply, but manufacturing employment grew during the month.
That's
so
interesting.
it's not a perfect predictor, but it's a sentiment indicator, and so people will be worried about the sentiment. But what we're really going to have to watch are things like jobless claims to see if we see companies starting to ramp up layoffs. Remember, July is distorted by a lot of other factors in terms of jobless claims, and we also had the hurricane in July, which we know distorted jobless claims. We aren't sure about the payroll figures, and we'll watch retail sales, see what consumers are doing. I was pointing out this morning that gasoline prices are falling.
Yep.
And mortgage rates are falling.
Yep.
There are some side benefits to this panic. And so are consumers going to give up? A lot of it depends on their impression of what the labor market is going to be like. So they could be worried, but we don't know yet.
So here's my question then. You look at WIRP, and we're still looking at 125 basis points now of cuts now priced into WIRP for the year. You have, JP Morgan, you have Citi saying they see 50 basis point cuts coming in September. Other Wall Street banks are saying, you know what? Michael Feroli saying you could probably do an interbank decision move if you need to. How does the Fed acknowledge the weakness and walk all that back in a short amount of time?
Well, they're not going to rush out and start trying to talk the markets off the ledge. I mean, if this is basically repricing because people got on the wrong side of a trade, and we're seeing a lot of changes in things like currency pairs because other central banks are doing things, and we've got geopolitical concerns out there. So the Fed is going to move slowly, watch what's going on, and at most, you might get people saying, we're going to do whatever we need to do, but they have to be careful because they don't want to promise say anything that will be taken as a promise that we're going to cut rates because anytime soon. But you look at what's happened, basically, beginning of the year, we were pricing 6 rate cuts.
Yeah.
Now we're pricing 6 rate cuts.
Exactly.
So, how accurate are the markets? How much should the Fed worry about them? As long as the markets are functioning, as long as you can trade, they're perfectly willing to let you lose money if you've made a bad trade.
So, I mean, I wish Lisa Abramowitz was here. She takes the week off. I can't believe somebody gives her the entire week off.
Oh, so maybe it was her fault, too.
Maybe it was her
fault.
She wasn't here Friday either.
She was off on Friday as well, so there's that. We're not even going to go there. But the yield curve isn't inverted anymore. And it's been a while since we had an inverted yield curve.
If you want to worry about the yield curve, and a lot of people don't anymore, but the yield curve always disinverts right before you go into recession.
Okay.
So you could say that's a negative sign, but overall, it's been disinverting for a while.
Yeah. All right.
Well, I guess my last question then, if it's disinverting for a while, sure, but the speed with which it does that, and I raised this question earlier, if we were super scared about growth, we'd sell the long end, we wouldn't buy it.
Well,
in theory.
That depends on what you think the Fed is going to do. I mean, if you think the Fed is going to be cutting rates, then you're going to expect the long end yields on the long end to be falling. So people would be buying 10s or 30s, depending on
a lot going on.
We get it. Do we get it now? Is it all ironed out? I don't know.
It's not all ironed out, but I think Alfred E. Newman is your guide today. What me worry?
What me worry? Exactly. Michael McKee, thank you so much. We appreciate it. Michael McKee doing all the economic stuff for Bloomberg Television. Matthew from Westchester writes in and says, "Don't forget about Warren Buffett blowing out his Bank of America stake, selling off half of his Apple stake. That's not good for the market. Is that a negative signal?
But that's backward looking. He already did it. And what's the problem with taking profits and putting it in cash to wait to do something else?
I mean, he's already got like $100 gajillion worth of cash But
so the idea is like, why does he need more? What is he worried about? Yada yada yada. I don't know. I feel like looking at those things is a tricky indicator.
Yeah. Okay. We'll figure it out. But at least Matt from Westchester is paying attention. We appreciate that.
We do appreciate
S&P futures off 3.4%. Nasdaq off. Let's call it a nice round 5%. 930 points. That gets you to 17,625 on your Nasdaq E-mini futures here. WTI crude oil, calling that out for Alex, off 2.3%. Under $72 per barrel for WTI crude oil. Make note of that. We'll have more coming up. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
We're addicted to the parlor game, the Fed, the monetary ballet.
Where do you see opportunities in a fixed income space here in 24?
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news. Another legal setback for Donald Trump, this time across the pond. The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, coming up in this hour, we're going to break down these markets. Again, we have a sell-off here of some pretty significant magnitude here. S&P off 3%, the NASDAQ off 4.8%, and we got a big movement in the yield curve here. A lot of smart folks to chat with this hour. Kicking it off with Melissa Otto, head of TMT Research at S&P Global Visible Alpha. Do you buy some of these tech names on the sell-off here? A lot of people, Alex, have been waiting for entry points into the NVIDIAs of the world, the Microsofts of the world, maybe the Amazons of the world. Is this pullback in the market? Is that an entry point for some of these people?
I think it's a really valid question. Or do you have to wait for everything to calm down a little bit before you dip your toe in again?
Wait for everything to calm down. So we'll have that coming up. David Samra, Managing Director at Artisan Partners, also can discuss value investing. That's coming up in this hour as well. Right now, let's go to Lisa Mateo and get a Bloomberg Business Flash.
Yeah, and a lot going on. The global stock sell-off deepens. European stocks set for their biggest three-day decline in 2 years. So we have the Stock 600 down 3%. The DAX in Germany down 3% as well. We have the CAC in Paris and the FTSE in London both down more than 2.5%. We head over to Japan, the Nikkei, that's down 12%. We have the Topix index fell 12%. That makes the index's three-day drop the largest in data stretching back to 1959. The Kospi right now down about 8%. To currencies, we have the dollar weaker, the Japanese yen stronger, up about 2.5% at 142.43 against the dollar. The Nasdaq 100 set for its biggest opening drop more than 4 years, and this is after entering into a technical correction on Friday. So investors kind of worried about whether that heavy investment into AI is going to live up to the hype. We have Nasdaq futures down more than 4.5%, 861 points. Dow futures down more than 2%. We have S&P futures down more than 3%. Among the biggest losers, we're talking tech. NVIDIA down 12%. Reports that its highly anticipated Blackwell chips will be delayed due to design flaws. You have Tesla plunging 8%, Microsoft falling 6%, Meta and Amazon down 6% too, and Alphabet down more than 5%. And we can't forget Apple. Their shares taking a hit too. Word that Berkshire Hathaway slashed its stake in the company by almost 50%. So we have Apple shares down more than 7%. To the bond market, the 2-year yield 3.73%, down 15 basis points, and the 10-year yield 3.71%, and that's down 7 basis points. That is your Bloomberg Business Flash. Whew, Paul and Alex.
Lisa, I think you're making up some of these numbers here, but they're right on my screen, so I know you're telling the truth. You speak the truth. Lisa Mateo, thank you so much. We appreciate it. Alix Steel sitting in for Tom Keene here this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can get that video thing, youtube.com, search Bloomberg Podcast. We're in your dashboard, too. I fixed my Apple CarPlay. I fixed my iPhone. We're back in the Beamer, so the Apple CarPlay.
Wait, you fixed your iPhone? I thought your iPhone was bad.
It's a little temperamental. You got to do some little jerry-rigging here to fix it, but it's all good. And we're the Android Auto as well. So we're all doing all the technology here at Bloomberg Surveillance. Melissa Otto joins us here, head of TMT Research, S&P Global Visible Alpha. Melissa, we were just hearing Lisa Mateo rattle off some of these pre-market trading numbers for some of these big tech names like Apple, like NVIDIA. Are these entry points? I think if you had told somebody, Thursday afternoon, hey, I can give you NVIDIA 30% off its recent highs, I think most of the people in the market would jump at that opportunity. Well, you have that opportunity here pre-market. What do you think about some of these big tech names, Melissa?
Good morning. Thank you. It's a wild one on this Monday morning. It's all about expectations, and NVIDIA is certainly a company that has very high expectations. So it's critical to believe in the direction of that company and where it's going. And the Blackwell series is expected over the next couple of years to generate sales of over $100 billion. So, ultimately, the company has to deliver on those fundamentals for the expectations to meet where they are.
So does that mean that if we have reports, there were reports that NVIDIA had some production delays? Okay, if they can't produce the stuff, even if the demand is there, they can't book the revenue. So could part of the sell-off in NVIDIA actually be fundamental at this point, or no?
It may be. I mean, we haven't had an official statement from the company to verify that, but that's certainly something that could impact their numbers.
Let's just kind of look in the rearview mirror just a little bit here. Some of the recent earnings we've had out of some of the tech folks. Apple generally in line. Microsoft, Amazon, Alphabet, Netflix. I don't know. I mean, I guess a smidge disappointing, a little bit. What do you make of the earnings of these big tech names?
It goes back to expectations. Coming into the quarter, expectations were high about both what the companies were going to deliver and what the outlooks were going to be like. So companies, in order to generate an additional leg of alpha to justify the valuations and what's actually priced into the stock, companies needed to exceed that. And if they're not, then it's disappointing to the market. It's disappointing to investors, and they will look for opportunities elsewhere where they can get a better valuation and more upside.
How do you think technology companies need to relay to the market their CapEx investment versus their profitability? Like Meta clearly did a good job of that. Like they showed that AI was helping to impact the amount of money they could make per ad that they sold. How do other companies that don't have that avenue deal with that?
Yeah, absolutely. This cash dimension to the mega caps is an absolutely critical one, because we've been in an environment where rates have been rising. So if you're sitting on cash, your cash is getting a really nice return. So it gives companies a lot more freedom to invest it, and it makes that cash flow potential a lot stronger. And the mega cap tech companies have enormous cash positions. So now in an environment where that is potentially reversing, coupled with the fact that they're accelerating CapEx, it presents some interesting questions about what their cash flow positions are going to look like over the next 12 to 24 months.
So, Melissa, given some of the pullback we've seen in some of these tech names, what are some of the best opportunities in your coverage universe?
Overall, one of the things we're looking at really carefully is what is going to really trigger broad adoption of generative AI. We know there's an AI revolution out there happening, but there needs to be a trigger point where these companies are either internally adopting generative AI in a way that's giving them a competitive advantage, or they're crafting and creating an application that is going to revolutionize the way users, enterprises interact and become more productive. So that is really the critical nexus point, I think, where we're looking at what companies are actually going to be doing that. And that's really, I think, where we are with the generative AI revolution right now, and where mega cap and just tech stocks in general really are going into the second half of the year and next year.
So anecdotally, let me tell you the story. So yesterday, my best friend's moving to Costa Rica with her family for a year. So there's like a going away party, yada, yada. One of my friends is a consultant. One of my other friends also is deeply involved in the market. And guess what the conversation was between the two of them?
AI.
Yes. How much AWS comprises their budget, and how much that's going to continue to grow with AI, and doubt that they're really going to see the benefit of that kind of money. And I'm wondering then, at what point do customers, like one of my friends, pushes back and says, you know what, Amazon Web Service, I'm not going to pay you that money. I don't want to do that. I don't see the benefit to AI in that sense.
That's $1 million question. I mean, Amazon was an interesting one this quarter because their AWS business was very robust. It basically carried the whole company. It beat the quarter and it had a strong outlook. Their margin beat by over 300 basis points. There was an adjustment in there of 200 basis points, but still it came in over 35%. But when we look at the other side of the Amazon story on the North America retail margin, that came in soft. That business coming into the quarter was expected to generate a 5.9% margin, but it came in at 5.7%. And the company said, well, as we look out at our guidance, we, kind of don't really see the profitability coming in that strong. And it actually came in below where the consensus was. Consensus was about $15.7 billion in operating profit, and the top of their range was around $15 billion. So it was like, whoa, wait a second.
Right.
You've got AWS doing really well, but what else is in there that's potentially diluting it? Or is AWS, to your point, potentially slowing down a little bit, or we're not seeing the profitability that we have been seeing?
All right, Melissa, a lot to think about here in the big tech space. Melissa Otto, head of TMT Research, S&P Global Visible Alpha. Again, S&P, the NASDAQ futures off 5%, 943.17,600 for the NASDAQ E-mini futures. With our news in New York City, here's Mr. John Tucker.
All right, Paul and Alex. Hurricane Debbie has come ashore in the Big Bend of Florida's west coast. Many residents already cleared out.
Crazy. It's the desolate look is just bizarre because usually you see people running and exercising all the time, but today's not the day for that.
Now, Bloomberg meteorologist Rob Carolyn says rain totals could reach a foot or more. Communities near Savannah, Georgia could see up to 20 inches of rain and as high as 30 inches in isolated areas. In the presidential race, Kamala Harris is in the final stretch of choosing her running mate. Sources are telling Bloomberg the vice president met with at least 3 possible candidates yesterday: Mark Kelly, Josh Shapiro, and Tim Walz. Harris is scheduled to kick off a 7 battleground state tour tomorrow with her running mate in Philadelphia. Israel bracing for possible attacks from Iran and regional militias after the high-profile assassinations of Hamas and Hezbollah leaders last week. Prime Minister Netanyahu says his country is in, quote, a multi-front war against Iran's axis of evil. But the White House is urging Netanyahu to redouble ceasefire negotiations with Hamas, even as the U.S. moves in a fighter jet squadron and keeps an aircraft carrier in the area. Here's Deputy National Security Advisor Jonathan Feiner.
What we're trying to do is prepare for any eventuality, any possibility. That's only responsible for the United States. Obviously, we've been quite clear that we will work with our ally Israel to defend itself against any threats that it faces, and we are in a moment that appears to be of heightened threat.
The White House Deputy National Security Advisor John Feiner making those comments on CBS's Face the Nation, heard Sundays right here on Bloomberg Radio. On the balance beam, American gymnastics star Simone Biles slipped and fell at the end of her series during the Paris Game Finals, and that denies her an opportunity to add to the bronzes she won on the event in the 2016 and 2020 Games, wearing a blue and white leotard featuring over 5,000 crystals. Maybe that was the problem. Biles was more than halfway through her set when she couldn't quite keep her balance. Global news, 24 hours a day. Whenever you want it with Bloomberg News Now. I'm John Tucker. This is Bloomberg. Paul and Alex.
And Sweeney Lee also fell.
Really?
So, yeah, she's one of our teammates.
Yes.
So that was something. And then the floor is happening just about 10 minutes time.
Okay.
She's going third to last. Her other teammate is going last, Jordan Childs. So we'll see if she can redeem herself. It seems like Simone Biles does really well when she's mad.
Yes.
And she must be mad. So let's see how that goes.
And the floor,
She's the hardest floor routine in the world.
Amazing. Yeah.
I mean, she's the hardest ball. I mean, she did a lot of hard things in the world. That's why it was so staggering when she fell. I was
losing your balance on the balance beam is a problem.
Yeah, so she was doing her aerial, so she does a couple tricks with no hands, and she just, if you can't make the 4-inch beam, you just can't make it, and therefore thus you fall. I was super focused on surveillance, by the way. Don't let my knowledge
of this routine
right now
lay the fact that
exactly. I'm still anyway.
The video may or may not be up on.
She's multitasking.
She's multitasking.
As one does.
As one does. John Tucker, thank you so much. We appreciate that. Again, sell-off in the markets. NASDAQ off 5.2%. The selling continues to accelerate here. The S&P off 3.7%, 5175 on your S&P 500. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Red on the screen, concerns about a U.S. economic slowdown kind of intensifying. Traders ramping up bets that the Fed will step in with an emergency interest rate cut. Economists at Goldman Sachs increased that probability of a U.S. recession in the next year to 25% from 15%, but added that there are reasons not to fear a slump. So right now we have NASDAQ futures down 5%, S&P futures down more than 3.5%, Dow futures down more than 2.5%. Bitcoin also taking a hit, down 14%, 50,820. Cryptocurrency linked companies taking a look at that. Coinbase Global, Marathon Digital, they were down more than 14%. We have MicroStrategy, they were falling about 17%. We head over to the bond market. We have the 2-year yield at 3.71%, down 16 basis points. The yield on the 10-year, 3.70%. And that's down about 8 basis points. The VIX, the so-called fear gauge, yes, at the highest level since 2020. On the economic calendar, we get a look at the service sector with a report from the Institute of Supply Management. And then that Russia quarterly earnings continues this week. We're going to hear from companies that include Disney, CVS Health, Uber, Novo Nordisk, and also Yum Brands. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate it. Alix Steel sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. The Summer Games updates via Alix Steel are brought to you by State Street Global Advisors. So we appreciate their support of these Olympics. Again, the Simone Biles will be starting her floor routine in moments, right?
The floor exercise for the individuals starts in about 15 minutes time. She's third to last. Jordan Childs will be performing last. She's also the U.S. Competitor.
That's brought to you by State Street. We thank them, our good friends up in Boston. But you look at this VIX, as Lisa was reporting, up 33.7 points, 57.3. We haven't seen that, again, as Lisa was mentioning, since 2020.
No, I mean, this is crazy.
It's just...
And I mentioned earlier, the curve, if you looked at it, it just has so inverted so quickly just from like a week ago. It looked like we might have gotten some stabilization in the equity market, pre-market, and that has kind of gone out the window now. We're seeing a definite rollover in S&P futures, now down almost 4% on the S&P futures.
Yeah, when Tom Keene comes back, he's not even going to be able to really recognize his screen with the VIX where it is today. And Bitcoin off 14.5% to 50,500. What does that tell us? I have no idea. But Mike McGlone knows. He covers all this commodity stuff, including the cryptos for Bloomberg Intelligence. I don't care what anybody else says. He's our go-to guy. Mike, what are you seeing in crypto off 14.5% today? What's that telling you?
The first thing, Paul, is the difference between 14% and the actual change from Friday, which is about 20%, is what you're seeing is Bitcoin from Sunday's market close, but from Friday's market close. Bitcoin, it changed this week. I mean, it trades on weekends, and I made the mistake of watching it because I thought it was going to break down. Once it broke through 60, it led the way, showed you where everything is going. But that's the key thing about things like Bitcoin. And this is an environment, you don't sell what you want to sell. You sell what you got to sell. So what you can. There were so much profits in Bitcoin, so much money, and so much massive speculation. You're just hitting the bid. So the key thing right now is, can it hold 50,000 support? I think it's unlikely. And then the key thing you have to point out is virtually every market I watch has been leading this and telling us we're going this. I mean, crude oil's that dropped, copper's dropped, gold's been going up. And most of those, except for gold, most of those markets are below their 200-day moving averages. Let's just make one key point. The S&P 500 200-day moving average is about 5,000. We're still well above that level.
So, Mike, is that what you're really getting at here, that you have to go cover other positions? You got to cover your yen carry trades. If you're losing somewhere else, you got to cover, and that's why, say, gold and Bitcoin are selling off?
Yeah, exactly. Well, I think gold's the more enduring one to rally. I've been pointing that out for a while, but you got to expect to be hitting bids now. And in this environment, we all know the only thing that really does well is if it doesn't have a designated put on beta, then it's the treasuries. And that's one thing that we all know is that, I mean, the U.S. Treasury market's been beat up so much. Treasury bonds, I think, are the main place to go.
So, Mike, you've been a trader for forever. You're trading commodities in the pits. What's this activity we've seen Friday and then here in the pre-market? What's just the trading? What's the tape telling you here? Is this panic?
Oh man, but I love when you bring back memories of being in the pits. And one lesson you learn is when the market goes down on a Friday, it's almost always go with on a Monday, particularly when you have volatility picking up. I just reread the book called Unknown Market Wizards by Jack Schweiger. I used to know a lot of those people that he mentioned in the first Market Wizards, and that's the key thing that's going on here. This is autocorrelation. That's all this is we're just correcting very expensive levels. That's the key thing. The indicators from commodities are doing that for right now. But right now, it's global. You look what happened in Nikkei, it was down about 15%. It's just all catching up, and I think what this is, it's just pointing out that the macro big picture is, to me, this is as bad as 2008, and for one key reason. I just saw in the chat this morning, people say cash levels are high. No, cash levels as per market cap of GDP are very low. In fact, they're well below where they were right before the financial crisis, around 10% now versus closer to 15% then. So it's just how expensive things are, and all we're doing is reverting now. So let's get back to that 200-day moving average in S&P 500. You know what everybody's going to say, buy the dip, but I think it's different this time. We're way overdue for just a normal bear market.
So this means don't buy the dip, or don't buy it yet.
Sell the rips. I don't see, and so I have to admit, so I went back this week and I rehashed a headline I've been writing for almost starting 2 years ago, starting the Great Reset. Now, yes, I was early, and if I was a trader, I would have been stopped out and maybe fired. But now that's the way things work. We're all tilting that way. Now, we still have an inverted curve. If you look at Fed funds at 30s, we have volatility bottoming from extremely low levels. And there's so many, and look at the economic surprise index. It's the lowest in a decade. So this is not just one payroll number. It's just the market figuring out that the whole world is just starting to tilt into recession. I like to go to one key indicator, and that's the U.S., the 10-year note yield in China. It's at 2.15%. Now, our colleague Stephen Sweeney writes about this all the time. He points out that China's government is doing everything they can to keep rates up. Yet there's so much of a flight to quality in the second largest economy. It's pushing those T-bond rates down. And that's my key premise is we're going to get deflation worthy of the inflation. We're getting into commodities, and those U.S. bond yields will probably follow what we're seeing in China.
The VIX blows out, up 150%, 35 points to 58.5. What does a move like that tell you?
It's exactly the same signal, very close to it, that I got in starting 2006. When the VIX stays down at a very low level for a 52-week basis, subtract out the T-bill, the levels we just are bouncing from now, which is around 9%, are the lowest since 2007, great financial crisis. A lesson I learned in the trading pits, let's bring those all back today, is volatility is always mean reverting. It's just reverting up. The question is how high it goes. So I think this is day one. I think we're supposed to be selling the rips, and there's going to be a lot of rips. But the overall situation is we are finally heading towards that recession, and we have the market cap of the U.S. stock market 2 times GDP. Mm-hmm. Before the great financial crisis, is about 1.3 to 3 times GDP. So there's just a lot of room for a little bit of wealth destruction, unfortunately.
Well, real quick then, as the VIX picks up, do correlations pick up, which then means that the VIX picks up even more?
Yeah, so I don't know how high it goes, but it's just a point. The key point there is correlations pick up, and one of the key leading indicators is Bitcoin. Why are all commodities down? Why is copper down? When beta goes down like this, everything falls, and people are hitting stops. And I think the key thing is be careful. The people who've been saying buy dips since 2009, because at some point you run out of money and we get too high. So I look at this way: look for levels to be selling rallies, and that's one thing we have to remember. There's a lot of tactically oriented people, of which I was. I used to cover, who are doing very well in this environment. And so it's a question of how far it goes. But right now, 5,000 in S&P 500 is good support. We probably should get a bounce from there. But overall, I think this is the turn, and the Fed will ease, but they will ease at and basically on the scale of the escalator going down versus the elevator that went up, which is a reversal of what we've seen in most of our lifetimes.
All right, Mike, thanks so much for joining us. Mike Malone covers all the commodities for Bloomberg Intelligence. He's down in Miami. You know, Alix, you and I may be going down to Miami in October, I believe, for a remote. And if so, Mike Malone's taking us out.
Oh, yeah, we're totally crashing.
And he's paying. We're going to tell him to make up the guest rooms. We're going to be coming. We're crashing in his place. But Mike does all the commodities for us, including the crypto. So appreciate getting an update there. Again, Bitcoin off of just about 15% off of the Sunday close. But as Mike pointed out, more than 20% off of the Friday close. So big moves in the crypto space, mirroring what we're seeing across the market. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Global stock markets tumbling, tech shares really taking a hit. NVIDIA, one of the biggest decliners this morning, down more than 14%. This is after reports that design flaws could delay its latest generation of AI chips. We have Tesla plunging 9%, Meta and Amazon down more than 8%, Microsoft falling more than 5%. We have Alphabet down more than 6%. And of course, can't forget Apple, down more than 9%. Berkshire Hathaway slashed its stake in the company by almost 50%. Let's get to NASDAQ futures, now down more than 5.5%. We have S&P futures down nearly 4.5%. Dow futures down more than 3%. We'll take a look at the bond market. The 2-year yield at 3.69%, down 18 basis points. The yield on the 10-year 3.69%, and that's down 10 basis points. We get to commodities because there you go. Oil lower. Brent crude $75 a barrel. WTI crude $72 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Economic indicators today are brought to you by Commonwealth and supporting more than 2,000 independent financial advisors with 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to Commonwealth.com to learn more about our consultative support and technology. We thank our good friends at Commonwealth. Let's turn to a professional here because these markets are moving big. NASDAQ down 5.9%, the lowest of the pre-market trading here intraday. David Katz joins us, President and Chief Investment Officer of Matrix Asset Advisors. David, I was just reading through your notes here. Quote, we look for stocks to end the year higher than current levels, but expect a lot of volatility along the way. I guess that's what you're talking about Friday and today. What do you make of it?
You know, we wouldn't say per se that it's healthy, but it is normal. Stocks go up and down. You just had a period where stocks are up for the last 9 to 12 months pretty consistently without a significant correction. You're having that correction now. It's very important to put this in perspective. Turn down the noise. If you look out 6 to 12 months, we think the economy is good. The Fed is going to be lowering interest rates. Earnings are actually coming through very good. 79% of companies are beating. So we think it's a generally good environment. After you get rid of the panic selling, we think stocks are going to be going higher. Mm-hmm. We take a little bit of issue with the last reporter, which was talking about don't buy the dips. We think buying the dips is going to be very profitable here. And after the market opens and you have this sell-off, and once it stabilizes, we do think you want to start putting money to work. We think there are a lot of really good businesses at very attractive prices that are on sale.
Just looking at the NASDAQ futures, accelerating the sell-off here in the pre-market off 6.1%.
When do you buy the dip?
Well, we think if you have a 6 to 12 month time horizon, once you see the market stabilize today, you actually can put your feet back into the water. We don't know if we would put all of the money that you're intending to put in today, but we do think that if you're talking about the market being down 5 to 6% on the open, that there's a pretty good likelihood that even 3 months from now, stocks are going to be meaningfully higher. If you look at things on a stock-by-stock basis, there are a lot of really good businesses. There are very attractive prices after today's sell-off. We would take advantage of that typically. And as you mentioned, I've been through this a lot of times. I've been doing this for about 40 years. You feel really stupid the next day and the next week. And then 3 and 6 months from now, you're kicking yourself for not having bought more. We do think the fundamentals are intact. We do think you can buy into this weakness. We would not panic out of stocks here.
How about for some of the big tech names? I'm looking at, just for example, the pre-market trading for somebody like an NVIDIA on a pre-market basis, down 20% from its high here. Even some of these big tech names, which have been arguably overvalued in some people's minds, now pulling back. Are these some entry points for some of the big tech?
So we think for a lot of them, it's a little bit early. However, there are a number that we do think you can buy here. Microsoft had a very good quarter, very good outlook, yet the stock is down significantly. We think that you can buy that. Qualcomm, which is a play on AI semiconductor chips, was at about 30% higher. That's going to be off. We think that's a very good entry point. Apple's going to be off on Warren Buffett significantly reducing his stake in that. Sub 200, we think if you, again, are looking out 6 to 12 months, that's a good entry point. We do think the next iPhone generation is going to be an AI upgrade cycle. So there definitely are a lot of good things out there. However, we would still not buy companies that are above 40 and 50 times earnings. So we think you're probably a little bit early on the video. We worry about that. But other places you definitely can buy. The banks are getting really beaten up here. Fundamentals are good. Banks benefit by the Fed starting to lower rates. So we think that you can start to buy banks into this sell-off. And then there are a number of other companies in lots of different areas of the market that we think are pretty attractive here.
Like where? I mean, I feel like this is a when, where, what, how. It's like, okay, when do you buy the dip and where do you buy the dip? You mentioned banks. What else?
So in terms of when you buy the dip, we think you definitely can start today. Look at it on a stock-by-stock basis. We do think industrials are fine, then sort of one-off places. PayPal had a very good quarter. The stock is off significantly on this sell-off. I think it's a great entry point. TE Connectivity, which makes electronics for anything to do with communication, we think is going to be at a very attractive price. Starbucks, which as an activist had a not as bad as expected quarter, also at a very attractive price. So lots of different things in the market. One of the things that we probably wouldn't do would be buy companies like utilities or consumer staples on a day like today, because generally they will hold up better in a sell-off. So we wouldn't be jumping into those for safety. We'd rather be buying the things that are getting beaten up.
David, what do you think this Federal Reserve is going to do? I think there's some discussion over the weekend that maybe there might be an emergency rate cut before the September scheduled meeting. Is that something you think is reasonable to expect?
Well, the markets are really dynamic now. So if the Fed thought that they had to help the system, they might do that. Our general thinking going into today, before we're seeing today's action, is they probably can wait. In terms of the economy, we think it's fine for them waiting until September. If they need to stabilize the financial system because what happened in Japan continues here, they possibly could. But we don't think that that is something that has to be done or probably should be done. But it is dynamic. That could change on a day-to-day basis.
Do you like anything in small caps right now? It felt like the reason to buy small caps was because of the price, but now the price is re-rated such, and then earnings are still a question mark. So is there a case to buy small caps or no?
So we have liked small caps because they have done so poorly this year. That changed in the last month where they really had a significant rally. We think they're going to be marked down sharply, probably today. Again, if you have that 12 or 18-month time horizon, we think small caps are attractively valued, especially attractively valued relative to large caps. They will benefit by the Fed lowering rates. And it's important to remember, when the Fed lowers rates once, it's not going to be a one and done. They are going to be lowering rates over the next 12 to 18 months. That should be a good environment for small caps. Value has lagged growth for the last year and a half. We think value is going to be a very good place to be. Again, not today because they're probably going to hold up better than some of the growthier areas of the market. And we think international, not Japan, but international like Europe, also is going to be a good place to be over the next 6 to 12 months. All of these prices are getting marked down during this global sell-off. If you have that longer time horizon, this is a good time to be putting money to work. Again, not jumping in with everything today, but definitely buying the very significant sell-off.
David, what are you making of the earnings cycle that we're in right now? It seems to be pretty solid for most companies. What do you take away from it?
So that's a great point. Earnings are very solid. Companies are beating expectations by about 79%, which is a little bit better than average. So good earnings season. However, if you miss or if you say anything in terms of your outlook that's disappointing, the market has taken the stocks out and shot them. So our advice to investors on that is, unless you know a company really well and have a lot of confidence that they're going to beat earnings, we wouldn't put money to work in a company before they release earnings. However, if a stock sells off and you like it, buy that dip. So Amazon had a modestly disappointing outlook last week. The stock got taken out and shot. It's going to get taken out and shot today. We think you can buy something like that on weakness. I'd mentioned Qualcomm earlier. Qualcomm had a good quarter, a better than expected outlook, but the stock got beaten up really badly on this overall concerns about the market. Buy that dip. But overall, earnings season is coming in good.
I just want to point out, guys, that the 2-year yield is now down 23 basis points. 10-year yield is off by 12. 23 basis points. That's
Holy
tremendous.
bonds, Batman.
Yeah, that's what I said. Wait, are you in this chat now? Do you read IB, John Tucker?
Again, Lisa Abramowitz takes this day off, this week off
Unreal.
when the bond move. All right, David Katz, thank you so much for joining us. David Katz, he's the president and chief investment officer, Matrix Asset Advisors. The 2 years, Alex was mentioning, down 23 basis points, 3.65 on your 2-year. The 10-year Treasury, 3.66, so pretty much right there, parity, the 2s and the 10s. And we had I think the peak of the yield curve inversion a little bit north of 100 basis points a couple of years ago. So it's
not even like a year ago.
A year ago, okay.
It's not even that long ago. We
Yep.
haven't seen this kind of flip for the 210 since July of 2022.
All right, very good. We'll keep on top of this market and the pre-market sell-off here. Let's go to John Tucker right now with the Bloomberg Business Flash. John.
All right, Paul and Alex, tracking the hurricane. Hurricane Debbie has made landfall in Florida's Big Bend region, where residents have fled ahead of a potential week-long disaster across the south. Bloomberg meteorologist Rob Carolyn is tracking the system for us.
Debbie is now located to the northeast of Horseshoe Beach, Florida, moving inland over the Big Bend area. It'll continue to weaken as it moves inland. It'll be producing heavy rain and high winds across northern Florida and into portions of southern and southeastern Georgia today. Once the system gets to eastern Georgia, it's expected to move rather slowly, and it could end up producing some very heavy rain over eastern Georgia and South Carolina during the first half of the work week. We are concerned about flooding across much of the southeastern part of South Carolina and eastern Georgia through midweek. I'm Rob Carolyn, Bloomberg Radio.
Top winds intensified to 80 miles per hour, making Debbie a Category 1 system. Israel bracing for possible attacks from Iran and regional militias. After the high-profile assassinations of Hamas and Hezbollah leaders last week, the Prime Minister Benjamin Netanyahu says his country is in a multi-front war against Iran's axis of evil. But the White House urging Netanyahu to redouble ceasefire negotiations, even as the U.S. moves in a fighter jet squadron and keeps an aircraft carrier in the region. Here's Deputy National Security Advisor Jonathan Feiner.
What we're trying to do is prepare for any eventuality, any possibility. That's only responsible for the United States. Obviously, we've been quite clear that we will work with our ally Israel to defend itself against any threats that it faces, and we are in a moment that appears to be of heightened threat.
And while the White House focuses on geopolitical tensions, Vice President Harris reportedly in the final stretch of choosing a running mate in her presidential campaign. Harris met Sunday with at least 3 possible running mates: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. This according to people familiar with her plans. The Prime Minister of Bangladesh has resigned, ending 15 years of rule. Nearly 100 people were killed, hundreds more injured Sunday as renewed anti-government protests swept across that country. And after 10 days in theaters, Deadpool and Wolverine, already the highest-grossing R-rated movie ever. In its second weekend, it collected $97 million, according to the studio estimates. Global news, 24 hours a day, whenever you want it, with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. You'll have to tell me what certain things meant in this movie.
Okay. Yeah, I got you.
No, I'm not going to ask now because
it
might give away the ending.
How much was your ticket?
Oh, I don't remember. I just whipped out the card. You know, at this point, stage of my life, I'm just like, here's my card.
For John Tucker.
I know that my son didn't pay for it. So.
And it was his idea.
Yeah, it was his idea. No, he said, let's go to the movies. I'm like, what are we seeing? He goes, no, you'll like it. I'm not going to tell you.
Now, knowing that you definitely probably would not like it.
Exactly.
Yeah.
Now, as a media analyst who thinks about these theater businesses, was a theater full?
For this theater, yes, it was very full.
Obviously, because the movie rocks.
For the first time in a long time, the audience actually cheered and clapped at the end of the movie.
Yes, because it's a good movie and it's awesome. Deadpool.
Deadpool.
He doesn't die, by the way. Just... He can't die.
I mean, Alex has been promoting this big time. I think you should get a cut of the box office, actually. S&P futures off 4%, NASDAQ off 5.4%, bumping off the lows. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
On the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Global stock markets really taking a hit. We'll start with the Stock 600 right now down more than 3.5%. The DAX in Germany, same there, down more than 3.5%. We have the CAC in Paris down more than 2.5%. The FTSE in London down 3%. We head over to the Nikkei down 12%. We have the Kospi down 8%. Over to currencies, we have the dollar weaker. Japanese yen up 3% at 142.04 against the dollar. Let's get to that tech sell-off. Leading the charge, NVIDIA down 13%. Chip makers including Intel, Advanced Micro Devices also plunging. They're both down about 7%. Tesla down 10%. And of course, Apple down 9%. Berkshire Hathaway slashed its stake in the company by almost 50%, so that's not helping. We have the bond market right now. The 2-year yield, 3.67%, down 21 basis points. We have the yields on the 10-year, 3.67%, and that's down 11 basis points. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that, of course. Alix Steel sitting in for Tom Keene this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Bloomberg Surveillance this morning is brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. Boy, the economic narrative really seemed to pivot on Friday with that weaker than expected jobs data, really calling into question the health of the U.S. economy and of the U.S. consumers. Let's get some color on that right now. We can do that with Anjee Solanki, National Director of Retail Services for the U.S. at Colliers. Anjee, thanks so much for joining us here. What's your view, Anjee, of kind of the U.S. consumer right now?
You know, it's really interesting when we look at the U.S. consumer. I mean, we've actually seen a slight, gain compared to June 24 to 23 by 2.3%. Although from prior month, it's been relatively unchanged. Now, we're forecasting a 2% at year end. And we're trying to kind of wrap our hands, around what's going on with the consumer. Paul, I'll just let you know, we're really seeing the consumer having so much convenience and ease of shopping with online or in store. I mean, it's really a frictionless type of shopping experience. So they're spending more.
All right. So I'm not into this back to school thing because my kids are grown, but my youngest, he's going to be starting a sophomore year in college, and we bought him his first suit yesterday. So that is my back to school shopping scenario. But Anjee, I know it's a thing for the retail space, back to school. How's that looking so far?
It's looking actually quite well. We've actually seen an early start to back to school. So right now it's about 8% up compared to what we've seen in the past. And I think people are refreshing their closets, just like your son with his suit. I mean, people are taking pride in what they're wearing.
Do you feel like we're going to see a value war, though, for back to school, similar to, say, fast food chains like McDonald's, Burger King, Wendy's? It's all about that value, right? How's that transmitting itself into the retail space?
Definitely, you're still seeing value. Look, there's still a discrepancy as it relates to wage and job growth and unemployment. So people are still managing their funds. They're being conscientious. They're taking their time and understanding how much to buy, where to buy, and how much time they're spending. So there is a value-driven component, but there still is that middle class and higher income, where they're still spending and not thinking too much about it, so there is still that hyper spend occurring.
How about some at the lower end? I'm thinking some of the dollar stores. How do they fare in this environment where, again, we really see a disparity in income and a disparity in retail spending, savings rates, credit card delinquencies? How are the dollar stores kind of seeing business today?
I think they're actually going to do quite well, with some changes that we've seen with 99-cent store closing. There's still a need, and therefore you're going to see them actually kind of rechange their merchandise and their product mix in their stores. So with that, there will be an increase in terms of the people going into that store spending, because at this point, with 99-cent no longer around, people have nowhere to go other than they're going to maybe shop in the Targets and Walmarts. But that 99-cent store and that dollar store is still bringing value. So you're still able to buy produce. You're still able to get, quick, grab and go items, batteries, household goods, napkins, etc. So I think there's still definitely going to be an increased foot traffic in those types of value stores.
what would you be telling, what area of retail has the most problems, and how would you tell them to solve that problem right now?
You know, when you look at retail overall, the grocery sector has been pretty steady. And what I really have noticed in terms of the grocery spend is that it's been seen in actually a very, slight increase, about 1.7%. And so when you stop and think about that, it has to do with the cost of the product and the goods within the stores. Also, I think if you stop and think about it, you can go into a quick serve. Yes, it's a little more expensive in terms of, the per person spend. But if you look at that versus, grocery, cooking at home, making your meals, doing the dishes, all of that, it might be a little more convenient. So, the quick serve restaurants, the fast food restaurants, although seeing a bit of a slowdown, it's still, they're still seeing quite a bit of pace. We're actually, from a retail perspective, in terms of leasing, we're actually seeing more quick service restaurants looking for space, looking to expand. So it hasn't slowed down in that part, but I would say groceries still trying to figure itself out.
How about luxury? We've seen some of the luxury retailers report some sluggish results of the most recent quarter, citing in part, the sluggish Chinese economy and lack really of outward bound travel by Chinese. How's the luxury space look to you?
It has slowed down. I would say that it's slowed down if you're comparing it to kind of the peak we had, during COVID and slightly after that. I wouldn't say it's completely, it's less than 2019. It's still, ramping. It's still in, I would say, maybe 15 to 20% from 2019. So we are seeing a slowdown. There definitely has been a slowdown as it relates to just the overseas. I think people are still looking at luxury. They've kind of spent during the last few years and have, kind of identified and purchased what they needed. So we are seeing a bit of that occurring at the moment. And also I think we're seeing, kind of that Chinese Asian consumer going elsewhere to spend in luxury, maybe not in the US.
That's interesting. Yeah, exactly. Like Chinese going to Japan, I think, because of that exchange rate. You have to wonder what happens after the last couple of days. But I want to I know this might be a little off field for a second, but in terms of EVs, we've had a lot of the car makers report, and it's been really ugly out there, particularly when it comes to sales, whether in China or in Europe, when it comes to EVs. However, can retailers, though, capitalize on this shift that we are eventually going to see?
I would say yes, for a couple of reasons. So what was really interesting when we started digging into these numbers was when we saw that foot traffic, so the actual footfall in stores, was starting to, drop. We started to dig why. Why is this happening? This is really for your large, major, retailers, big box retailers. Well, because they made it so easy to shop online, pick up in store, curbside pickup, etc., they started to notice that people were not spending as much time in the store. So by putting getting involved in that kind of retail or EV sector, you're really creating another reason for that consumer to come into the store and spend more time. So it's not a 15-minute in and out, but if I'm charging my car, if you have an EV car or vehicle, you can actually go in and you're going to, you may start buying things that you didn't even think about. So you're spending 30 minutes, 45 minutes, or even an hour in a store, you're going to be accumulating just things to purchase. So I think it's a little bit of that. Plus, it could be another additional revenue channel. They may be able to advertise specials. If you're sitting in your car, charging your car and waiting, you might see something that pops up that's going to drive you into the store to make a purchase.
Anjee, thanks so much for joining us. Always appreciate getting your thoughts on the retail side of the business. Anjee Solanki, National Director of Retail Services for the United States for Colliers. Looking at the futures market about 35 minutes before we open, S&P off 4.5%. The NASDAQ off 5.7% here. That's more than 1,000 points decline in the NASDAQ E-mini futures, keeping an eye on that. Yields. Two-year Treasury off 19 basis points, 3.69%. The 10-year Treasury off about 10 basis points to 3.69%. So that yield inversion has flattened out and is disinverted, I guess is maybe the right term.
Yeah,
so we'll
that's the
keep
right
an
word.
eye on that here. WTI crude oil off 1.3%, $72.
62.
Yep.
62 on the VIX.
On the VIX.
On the VIX.
This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Are these stocks under-owned by institutional Wall Street?
A lot of these companies talking about generative AI.
With Lisa Mateo on markets.
Investors just worried about the ongoing sales slump in China.
And Michael Barr with news.
A ship traveling through the southern Red Sea has been attacked.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, coming up in this hour, we're going to have some smart market discussion as we get ready for this market open. Today, we'll start it off strong. Lori Calvasina, RBC Capital Markets. Matt Siegel, head of digital assets research at Van Eck and Associates, talks about the route in crypto and Bitcoin. He's going to be in studio here. Kara Murphy is also going to join us, CIO at Kester Investment Management. Get her thoughts on these markets. Where are the opportunities across equities, fixed income, and alternatives? All that's coming up in the next hour. Right now, let's kick it all off with Lisa Mateo with the Bloomberg Business Flash. Lisa.
You got it. And the global stock sell-off continues. We'll start the European stocks set for their biggest three-day decline in 2 years. We'll start the stock 600 down more than 3%. We have the DAX in Germany, same there, down more than 3%. The CAC in Paris down more than 2.5%. We have the FTSE in London down 3%. Heading over to Japan, we have the Nikkei down 12%. Also, the Topix index fell 12%. That makes the index's three-day drop the largest in data stretching back to 1959. Led over to the Kospi down 8%. Currencies, we have the dollar weaker, Japanese yen stronger, up nearly 3% at 142.38 against the dollar. The NASDAQ 100 set for its biggest opening drop in more than 4 years. Right now, NASDAQ futures down just about 5.5%. We have Dow futures down 3%, S&P futures down more than 4%. Here's the breakdown about the tech. Let's get to the biggest decliners. NVIDIA down 13%. You have those reports that its Blackwell chips will be delayed due to design flaws. You have Tesla plunging 9%, Microsoft falling about 5%, Meta down 7%, Amazon down 8%, Alphabet, they're falling about 6%. Apple shares, can't forget those, they're taking a hit too after word that Berkshire Hathaway slashed its stake in the company by almost 50%. Apple down more than 10%. Finally, the two-year yield, 3.71%, down 16 basis points. The yield on the 10-year, 3.70%, and that's down 8 basis points. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alix Steel sitting in for Tom Keene here this morning. I'm Paul Sweeney. We're live here in the Bloomberg Interactive Brokers studio. We need some perspective on this market in a big way with some of those futures readings that Lisa was just reporting. And for that, we go to the lawn in Charlottesville, Virginia. Lori Calvasina, head of U.S. Equity Strategy, RBC Capital Markets. If you know what that means, you know. Lori, what do you make of the last couple of trading days here in the futures market here today? The market kind of turned on a dime there on that jobs number.
It did. Look, I think the biggest takeaway we have right now is people like Tom Keene going on vacation. I think everyone's going to be afraid to take vacation in August now. But I think the reality is that we have to take the last couple days in context. And that's what we really tried to remind people of in our weekly this morning. We're not sitting here saying recession fears didn't escalate, that there weren't some, signals in the jobs report and the ISM report on Thursday. But we do think people need to bear in mind that we had, I think I came up with like 6 or 7 different reasons that markets should be selling off right now. This includes valuations that were full, a tendency for the stock market to sell off after first rate cuts occur. So maybe we're pulling that forward. We had extremely elevated positioning on the CFTC data for U.S. equity futures, NASDAQ futures, S&P futures. AAII was sending us a sell signal the last couple weeks. We've got the election where dynamics are shifting that typically produces a pullback in September. Again, maybe we're pulling that up. And by the way, markets have been correlated with Trump, and now he's lagging behind Harris. So there's a lot of stuff going on. And by the way, add the fact that seasonality the last 5 years has been really, really poor time to be in the stock market, August through October, I think including specifically 2022 and 2023. So there have been a lot of reasons this market has needed to take a bit of a pullback in here.
So, Lori, it's Alex, and I love reading all your notes. It's like first must read on Monday, got to set you up, right? When does, though, a healthy correction become an unhealthy one?
So I think the biggest thing I'm worried about in here, and I'm trying to tell everybody, keep a calm head today. I do think we need to dig into the BLS report a bit more, find out exactly what the weather impact was there. But I do think that the rule of thumb I always use is 5 to 10% is a typical correction if you look from peak. So that would kind of take us down to sort of the 5,100 marks. We'd have to watch markets closely in here. If you look at sort of the 10 to 20% range, that's typically, in the post-GFC world where the growth scares settle in. Now, 2022 was a little bit different. It wasn't a recession. We fell 25%. But generally, anything more than 20% is an actual recession. And I think one of the reasons why it's so jarring, kind of the move from Wednesday to Thursday, Friday, is that if you go back to corporate earnings and equity investors, we've all had our heads stuck in these corporate reports the last couple of weeks. What we're seeing in that jobs data, it's not really syncing up with what we're hearing from companies right now. So I do think we need to sort of take it one step at a time in here.
Lori, what do you think the Federal Reserve is going to do here? There was some discussion over the weekend, maybe an emergency rate cut. What do you think they're going to do here?
So I have no idea. I think we have to talk to the rates crowd. We have to talk to some of the reporters. But the truth is, I don't. And I get a little bit frustrated with the Fed guessing game that people play on Wall Street all the time. I think they're looking at data. They're trying to make the best decisions that they can. But what I can tell you is this question has come up a few times since Friday, and even frankly since the CPI report. That's when my rate strategist was telling me he was first getting questions about 50 basis points. And I kind of went and dug up some of my work from SVB, looked through some of my files, and we found that in at least kind of my time on Wall Street, I started in 2000, when you either get sort of the big chunky cuts or you get the emergency cuts, generally they don't tend to happen in isolation. They tend to happen in bunches. So I worry a little bit that if we get some sort of emergency action, if we get some sort of big chunky cut, it could further spook the market. That's just my opinion, though. There are certainly people out there smarter on this than me.
No, I mean, it's a fair point. And there are a lot of people out there who trade equities who are in kind of your boat, right? So based on all of that, when and where do you buy the dip?
So I think we've got to take it one day at a time. I want to see sort of how the market reacts if we get down to that 10% threshold. I think that's sort of where we could look to see if there's a line in the sand. The other thing that's come up a bit this morning is just, sort of looking at valuations. We've been very elevated, for example, on those top 10 names in the broader market. In the S&P, you've been trading, you got up to 32 times on median PE, actually. It's now fallen down as of last Wednesday to around 27. Who knows where it is today? We'll see tomorrow. But I do think you want to sort of watch for some additional relief on those valuations. And I've noticed just in my career, a lot of times you don't have to get super cheap on things for the bleeding to stop. Sometimes you just need to get back to average, get a little bit below average. Small caps, for example, is the opposite phenomenon right now. They keep getting up to average and then the trade sort of peters out. So I think watching when we get back to average valuations on certain things is going to be critical.
So, Lori, I'm just looking at NVIDIA here in pre-market trading. The levels suggest a 30% pullback from its recent high.
Wow.
I mean, that gets your attention. I mean, if you told somebody you could buy, I'll give you NVIDIA at a 30% discount to its high, if you said that to them on Thursday, I think they'd grab it both hands. What do you think about some of these big tech names that have led the market higher and which are now taking the big brunt?
So when I think about the basket as a whole, I think that we've sort of hit a valuation ceiling. I mentioned, we kind of got up to 32 times on those top 10 names on a median PE. When it's hit sort of, the upper 20s, 30 in the past, that's really been the ceiling. So I think we kind of hit the ceiling on valuations. If you look at the growth rates on the Mag 7 versus the rest of the market, we've had a decelerating growth advantage. And so, those Mag 7 names had just ferocious earnings growth last year, but it's expected to decelerate both this year and next. It's hard to sustain the premium valuations when you've got a growth rate that's accelerating off peak, even if everything is fine. Mm-hmm. So I do think the valuations are really the key to the story here. We just need to see some additional relief.
The VIX has jumped an insane amount in 2 days. The curve is super inverted at this point. What kind of damage does a VIX that's moved the most in 30 years do to the equity market?
So look, I think it's a question of where does it settle out? I actually called someone this morning. I got to the office pretty early and it was around 50, and I called someone to say, is this real? Is this actually the real data point? So I'm glad you guys are reporting it as well. But I think the reality is it just tells me that we have a sentiment problem in the market. That sentiment needs to unwind. I mean, if you look at the CFTC data, Alex, the broader U.S. equity futures positioning across all of the buy side, so we add up 3 different categories together, it's been sitting above January 2018 levels. It's been sitting above February 2020 levels, and also above the levels of 2021, 2022, though frankly, those weren't nearly as high as what we saw back in the 2018 and 2020 timeframe. So there has just been, I don't think people necessarily have sounded rah-rah when you've talked to them, but if you've looked at the actual positioning data in the futures market, these are some of the levels that have historically just caused a tremendous amount of volatility, and we need to let that play out in here.
All right, Lori Calvasina, thank you so much for joining us. We know you're super busy today. Lori Calvasina, she's head of U.S. equity strategy at RBC Capital Markets, a voice that we really value during the course of our broadcasting day, and certainly on days like today where we've got the S&P off about 3.7%. And again, that VIX, as Alex was just pointing out, up 33 points to 56.9 on your VIX. That's a 143% increase.
We were at like
today.
12 like a week ago.
We were at 12, and we were at 12 for the longest time. So the fear index for the equity folks really gets your attention. With our news in New York City right now, here's John Tucker.
All right, Paul and Alex, the National Weather Service's Hurricane Debbie has made landfall near Steinhatchee, Florida. Bloomberg meteorologist Rob Carolyn says rain totals could reach a foot or more.
Debbie will make landfall later this morning over the Big Bend area of Florida, then move north-northeast across portions of northern Florida. It is going to bring high winds and also some very heavy rain to northeastern portions of the Big Bend area, also over northeastern Florida and southern Georgia. And then later this week, heavy rains will move into the Carolinas. John?
Communities near Savannah could see up to 20 inches of rain, as high as 30 inches in an isolated area. Israel bracing for retaliation after the assassination of a top Hezbollah and Hamas officials. Axios reports Secretary of State Blinken told G7 counterparts an attack by Iran and Hezbollah could start in 24 hours. Prime Minister Benjamin Netanyahu issued a warning to would-be attackers. Netanyahu himself is under pressure as the U.S. continues to press for a ceasefire deal in Gaza. Vice President Harris reportedly in the final stretch of choosing her running mate. That story from Bloomberg's Ed Baxter.
3 people on her short list met with her over the weekend: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. Kentucky Governor Andy Beshear, Transportation Secretary Pete Buttigieg, and Illinois Governor J.B. Pritzker also are names that are still being floated. Now, the Democratic Party is planning to virtually nominate a ticket by August 7th, and Harris has said that she plans to hit the campaign trail with her running mate tomorrow. Ed Baxter, Bloomberg Radio.
Nearly 100 people were killed, hundreds more injured Sunday as renewed anti-government protests swept across Bangladesh. And now comes word this morning that Prime Minister Sheikh Hasina has fled the country. The nation's army chief is saying he'll work to form an interim government. Global news 24 hours a day and whatever you wanted with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Paul and Alex.
All right, John Tucker, thank you so much. We appreciate it. All right, Alex, we got WTI crude oil off about 1% here, just under $73 a barrel. Big oil companies, where do they like to see it? I know higher, but where do they generally like to see oil these days?
What do they tell you, or what's real?
What's real?
What they're going to say is that they can get oil out of the Permian for like $30 or cheaper, or they really only need $50 or $60. That's how they do their budgeting. But you know what? Higher is definitely better. But you don't want to do demand destruction, because if you get too high, then no one will buy it because it's too expensive. But I should point out that oil in general has been getting hit along with copper because of growth fears out of China. But then Mike Wirth of Chevron told me on Friday that it's actually a supply thing. There's just too much supply. He sees demand as being fine. So go figure.
All right, supply and demand, it's a commodity. Another commodity, gold, pulling back 1.6% after the big run, $2,430 for gold right now. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Futures really taking a hit. Concerns about a U.S. economic slowdown intensifying. Traders ramping up those bets that the Fed will step in with emergency interest rate cut. Now, economists at Goldman Sachs, they increase that probability of a U.S. recession in next year to 25% from 15%. But they did add that there are reasons not to fear a slump. So let's get to the numbers. NASDAQ futures down 5%. We have S&P futures down more than 3.5%. Dow futures down more than 2.5%. Bitcoin also taking a hit. It was down as much as 16%, now down about 15% at 49,884. Cryptocurrency linked companies, we'll take a look at those. Coinbase Global down 17%. We have Marathon Digital down more than 19%. MicroStrategy falling 24%. Heading over to the bond market, the U.S. 2-year yield fell below the 10-year for the first time since July 2022. The latest update right now, the 2-year yield at 3.73%, down 15 basis points. A yield on the 10-year 3.68%, and that's down 10 basis points. You have the VIX, the so-called fear gauge. Yes, it's the highest level since 2020. Great. On the economic calendar for today, we get a look at the service sector. We have a report from ISM, 10 a.m. Wall Street time. And finally, Alex, I saw this story since you're the Olympics fan, okay? Mm-hmm. Noah Lyles, the fastest man in the world. He's sponsored by Adidas. He says he now wants his own signature Adidas shoe. There you go. He wants a piece. That is your Bloomberg business flash.
He also didn't win gold, but, you know, no.
That was crazy. Like, 10
crazy.
guys were photo finish.
Yeah.
Crazy. Yeah. Okay.
It was really
this
insane.
photo finish. Yep.
Yeah, but okay, sure. I mean, you know, maybe one day.
All right, Lisa. Thank you so much, Lisa Mateo. Thank you. We've got Alix Steel, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're doing a streaming thing. I think that's video. That's on YouTube.com. Search Bloomberg Podcast, and that's where you'll find us. The Summer Games updates are brought to you by State Street Global Advisors, so we appreciate their support. Has Simone done her floor thing yet?
No.
Okay, keep us up to date on that.
She actually probably is doing it right now.
Okay.
Now, granted, I'm not watching it, which is super sad for me, but I am looking at the scores.
You can do it. I mean, you can multitask. All right, I'm looking at Bitcoin off 15% today. McGlone pointed out you got to look at it over the last few days, off 25%. We're sitting right at $50,000, so it is getting hammered there. We talked to some folks on this crypto, but none more informed, I think, than our next guest, Matt Siegel. He's head of digital assets research at Van Eck Associates. Matt, is this just a normal market risk off? Things are getting smacked all over the place, so why not crypto? Or is there something else going on here with this big 25% move down in Bitcoin?
Yeah, it's that periodic rotation out of crypto and into poverty for Bitcoin investors. But I think most of this was sparked by the macro unwind of various carry trades. You know, the Japanese yen is the most notable, but there are carry trades in digital assets as well because of the generally upward sloping futures curve for Bitcoin and Ethereum. And crypto exchanges, because of this volatility, facilitated more than $1.5 billion worth of forced liquidations in the last 24 hours. That's a 52-week...
Forced liquidations. Wow. That's not good.
Well, it's better than having to call someone, a CEO, and asking them to liquidate a counterparty, and maybe there's stalling that happens, and the counterparties can get hurt. In crypto exchanges, that happens instantaneously. So it was a 52-week high in liquidations, more than $1.5 billion, lots of volatility.
Who's getting liquidated? Who's a typical entity that's being liquidated?
Speculators on leverage.
Okay.
I just want to point out that, correction here, Noah Lyles did win gold. It was just really, really tight.
Okay.
With Thompson from Jamaica. Anyway, back to the deleveraging. So how much more do you think this has to go? Because it's not necessarily a call on crypto or Bitcoin. It's like, look, I got a position, I got to fix, I got to cover my short here, I need to sell what's working. How much of that is still in the market?
Yeah, I think we're in the uncertainty phase right now where volatile assets are going to be volatile. If past this prologue, how this eventually ends is with policymakers stepping in with more liquidity, and that will sow the seeds of the next Bitcoin run. So in the end, this asset is a hedge on the fiscal recklessness that all of the G7 countries are embarking on. I should note that politics also played a role in this sell-off because the Kamala Harris odds rose above 50% for the first time all summer. She would be notably worse for most digital assets. So I think it's a couple different factors here.
I had somebody who I think is informed on this stuff, really made a big deal about Trump embracing crypto. And I said, isn't that just a political thing that somebody slipped him a note and say, go positive on crypto? He would know. I mean,
in this country, politicians respond to what the voters want. So this is a very popular asset class across both of the political parties, mostly young people who tend to vote, in increasing frequency. So unfortunately, VP Harris has not embraced the asset class with as much enthusiasm. And my sense is that, and this is what we saw in the last 24 hours, Bitcoin dominance, which refers to Bitcoin's market cap divided by the entire market cap of the asset class, reached a 52-week high as well yesterday. So I think that may be the story if Kamala Harris continues to gain in the polls, and when it would be Bitcoin dominance outperforms.
Where in the crypto space right now do you think is going to see the most downside? Is it going to be in the crypto stocks? Is it Ether? Is it going to be a Bitcoin? Like where do we see the most action in an environment like this?
During the uncertainty and deleveraging phase, it comes from anyone who has debt. So you mentioned some of these Bitcoin mining companies that are down sharply this morning. Some of them have debt. Those will be the ones that underperform. That's also the reason why you see Ethereum generally underperforming Bitcoin in a week tape, is because there's more leverage built into the Ethereum system than there is on Bitcoin.
We had a portfolio manager early this morning that said regarding the stock market, buy the dip. Simply his call today, buy the dip. Do you buy the dip in crypto?
It's pretty common to see these 25 to 30% corrections, even during Bitcoin bull markets. There's a couple of crypto-specific issues right now, notably a couple of bankrupt entities, Genesis and Mt. Gox, that have been paying out to creditors, and some of those may be selling their Bitcoins. So I think when this period of uncertainty ends, you're going to get a relief rally, and that'll be sharpest in Bitcoin and crypto. We continue to see outside the U.S., emerging markets, frontier nations mining Bitcoin in order to gain access to hard currency, and experimenting with the use of stable coins and Bitcoin in cross-border trade. So I think Americans will not feel that utility. We feel the speculative aspect, and that's what we see on the tape this morning.
What is liquidity like within the crypto market? I mean, we talk about liquidity being seasonal in the equity market. It's going to be hard to get a clean read on what's happening. Well, what's it like in Bitcoin? Do we know enough?
Bitcoin is pretty liquid asset, trades $30 to $50 billion a day.
So there's no like seasonality stuff that we should be worried about that we know
We
of?
haven't seen anything concerning. I mean, obviously the price is down a lot, but haven't seen anything concerning with liquidity.
Are there some technical levels? I mean, 50,000 feels like a technical level to me, but that doesn't mean much. So are there technicals for you?
I don't read too much into technicals because with an asset this volatile, you can overshoot or undershoot by 10%, and it would mean a big difference on the chart, but not as big in the context of this volatility. So the round numbers are always important. I hope we hold 50.
How about the Fed? We might even get an emergency rate cut, or at the very least, one or more rate cuts in September. That's presumably good for crypto, right?
That's been the past experience. We look back to the COVID meltdown in March 2020. Bitcoin was down 37% in one day. It was a 10x within 1 year of that. So I think investors are justifiably losing some confidence with Fed policy here. They were slow to raise rates. Now they're slow to cut rates. Bitcoin's monetary policy doesn't change, very predictable, and that's one reason why especially entities outside the U.S. have been increasing their adoption of it.
Okay. Matt, thanks so much for joining us yet again. Appreciate it. As always, keeps us up to date on what's happening in the world of crypto, because I have no idea. Matt Siegel, head of digital assets research at Van Eck. Looking at Bitcoin here today, again, off about 15% here, holding right at this $50,000 level. Over the last several trading days, off 25%. But I guess, as Matt Siegel has mentioned, we've seen this before, this type of volatility before. Speaking of volatility, the VIX out 32 points, 55 on your VIX. That's up 135%. So just a real blowout on the VIX here. And Tom Keene not here to witness it just makes it that much more dramatic. So we'll have more coming up. S&P off 3.7%. NASDAQ off 5%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo alongside Paul Sweeney and Alix Steel with your opening bell report. What a Monday it has been so far. The NASDAQ 100 set for its biggest opening drop in more than 4 years. And this is after entering into a technical correction on Friday. The global stock rout that began last week, it's intensifying. That's growing concerns about a weakening economy, also a Fed that's been a little bit too late to stop it. Let's see how things pan out to start this new trading week. We'll start with the S&P 500. Right now, down 4%, 222 points at 5,125. We have the Dow down 2.5%, 1,068 points, 38,664. We have the NASDAQ down 6%, 1,061 at 15,724. All right, let's get to the bond market. We have the 2-year yield, 3.74%. That's down 14 basis points. We have the 10-year yield at 4.69%. That's down 10 basis points. Let's take a global look right now. We have the DAX in Germany down 3%. Same for the Stoxx 600. We have the CAC in Paris down about 2%. We have the Nikkei down 12%. Currency, the dollar weaker. Japanese yen up 3% at 142.13 against the dollar. At the open, want to also check in with big tech, those stock movers. We have Nvidia down 14%, Tesla down 11%, Apple down 9%. That is your Bloomberg opening bell report. Paul and Alix.
I mean, Lisa's got to be making these numbers up, but I'm looking at my screen. That's exactly what's happening out there.
And also, can I just say, if you go to the GPO function, which shows the 50, 100, and 200-day moving averages on all the major indices or stocks, the NASDAQ 100 gapped below its 200-day moving average, means it opened below that level. It's a huge gap down, and the S&P is really close to doing something very similar. That's like these are major technical levels then that are being taken out.
I mean, a 1,000-point move in the NASDAQ, not the Dow, but the NASDAQ. That gets your attention off 6.2%. So, Lisa, thank you so much for bringing us up to date on that. We'll have market feeds all throughout the day today. Let's get right to a professional here because we need some talking to here. Kara Murphy's joins us. She's the CIO of Kestra Investment Management. Kara, what do you make of today? What do you make of the last couple of trading days? What's happened to this narrative for this market?
Well, it's pretty ugly out there. I'm not going to try and sugarcoat it. But let's not forget what the setup was in the market before we headed into this last round of bad economic data. We had multiple stock market indexes up very, very strong so far this year after a great 2023. We had payrolls that had outperformed expectations for about 7 months in a row. We had GDP that was raised for about 3 quarters in a row. Corporate earnings running about double-digit growth. So we had very, very strong performance, very strong economic growth, much stronger than what was expected earlier in the year. And then all of a sudden, we have a couple of data prints that tell us that the economy is indeed slowing. So, I think there was a little bit of air that needed to come out of the tires. Expectations had gotten too strong. But then throw on top of that, and we've been talking about this for a while, is to expect volatility in late summer. And here we are. And sometimes it's hard to predict exactly what that trigger is going to be, but the setup for it was really strong in that expectations were so high. And then throw in a presidential election where you typically see higher volatility in August. So I think all of this was ripe for a lot of volatility and churning in the markets.
When do you buy the dip?
I mean, I think you buy all along. This is not like a terrible time. You still have really strong economic growth underlying this. You still have the Fed that's going to cut interest rates. There's a lot of sort of chest beating about the Fed sort of missing this, but the Fed is not going to get it perfectly every time, just like we're not going to call the bottom or the top every time. So I think this is still, if you look on a 3-year out basis, this is still a really great market to be in.
So, Kara, I'm just looking at NVIDIA, one of the absolute darling stocks of this bull market here. It's the play on AI. It's down 30% from its high, and it just in a matter of days here. For the NVIDIAs of the world, the other Magnificent Seven, which had led this market higher, are these buys here, or do you start nibbling on them here, or still got room to go, do you think?
I think what we've seen recently is just showing that these stocks are mortal too, right? They can have downturns. They don't go up every single day. That said, we've been calling for a broader market for some time. And not to say that these names are going to, the Magnificent Seven are going to, turn down significantly. But I do think this is an opportunity to make sure that you're broadening out in your portfolio, because there's still a lot of great opportunities outside those big names.
Like where?
I think anytime you go a little bit down in cap, we think particularly mid cap is really attractive, where you have some really high quality companies that the market has largely kind of ignored for quite some time. And as you look at earnings trajectories later in the year, we're going to start to see some of those smaller companies begin to see stronger earnings. Now, if the economy is a little bit slower, that's going to be a bit more dicey. So what you want to do is be able to layer in a little bit smaller cap with high quality. So companies who have defensible earnings, strong balance sheets, all that good stuff.
Kara, some folks over the weekend have been suggesting, on the back of that weaker than expected labor data, that the Fed perhaps should do an emergency cut before the September meeting. What are your thoughts about that?
I think that's overreacting. Number one, labor data is notoriously volatile. So 1 month often does not make a trend. There are possibilities that there are seasonal factors at work. We saw higher labor rate participation. So there are some really good reasons to sort of wonder if that latest number is the right one. And think back to, an earlier emergency cut in March of 2020. I mean, the world felt like it was coming to an end and economic data was screeching to a halt. We don't have that today. I think the Fed has time.
Also, it's not just equities that are moving, although they're moving quite a bit. The Nasdaq 100 is off by 4.75%, below its 200-day moving average. The S&P gapping down, also off by about 4%. A really ugly combo over the last 2 days. It's also the bond market. Buying coming in, but yields are a little less dramatic than what we saw just an hour ago. The 2-year yield is only down now 13 basis points, and the difference between the 2s and the 10s coming in by, let's call it 6 basis points. Do you need to be in fixed income for safety or price appreciation, or what do you think?
I think a little bit of both, but I think it's encouraging to start to see correlations between the stock and bond market come down, right? We're seeing the bond market able to provide some sort of ballast in a diversified portfolio as stocks come down. But then also, as you think about as a pure fixed income investor, often your forward return is basically the yield that you're buying that bond at, right? Makes sense. And so right now we have yields that are at their highest level that we've seen largely in 10 years. So there's some good juice in there. So there are good reasons to own bonds on their own as well.
So talk to us about this earnings cycle. I mean, earnings still matter despite what we're seeing in the marketplace today. How have the earnings come in for you, and what are you looking for some of the names still to come?
So if you look broadly, we think the earnings season this year is pretty good. So you look at percent of beats, you look at how stocks are performing after a beat, you look at raises. Those are all sort of in line with what we would expect over the long term. What I think is really interesting is as you look a little bit deeper, the smaller you are, at least up until the last couple of days, the smaller the stock, the better the return after a beat. And so what that tells us is that the market is starting to show a preference for some of those smaller names. And again, I think we start to see that rotation into those names that still have a lot of earnings growth in the back half of the year.
So that doesn't mean that we have to wait for NVIDIA in a few weeks' time to save this market. Something else can save it?
Well, we'll see. Everyone will be watching that earnings report, no doubt. But there are 400 plus other names in the S&P 500 that are still really important. It's not just that one name.
Molly, what is a VIX that jumps out 28 points to over 50 in one day? What does that tell you? Kara, sorry.
Oh, that tells us that people are worried. I talked earlier about the VIX, the sort of setup heading into these last couple of days where, earnings were up a lot, stocks were up a lot, and VIX was really, really low. So that tells you that there's a fair amount of complacency in the market. Now it's up again. So in some ways that can be a really good buying indicator because suddenly there's a lot of fear in the market. People are running for the hills. I don't know that we're completely washed out and at a bottom just yet, but that's actually an encouraging sign if you're looking for an opportunity to buy in.
Interesting. All right, Kara, thank you so much for joining us as always. Kara Murphy, She's the CIO over there at Kestra Investment Management. The S&P, we're off 3.7% here today. The Dow's off at 3%. That's about 1,200 points there. NASDAQ off 4.8%. That's 800 points, bouncing off of the bottom. We were down more than 1,000 points earlier in the trading here, so bouncing off that bottom a little bit. 10-year yields, they come in about 8 basis points, 3.70% on your 10-year. The 2 years at 3.76. A little bit of an inversion there from what we saw earlier in the day. Right now, let's go to Lisa Mateo and get a sense of where we're seeing some more action in some of the big tech names. Lisa, what are you looking at?
Yeah, we'll start with NVIDIA right now, down 9%. We have Tesla down about 7%, Apple down 5%. We get to Microsoft, they're down more than 3.5%. Amazon taking a hit, down 5%. Alphabet down 3%. Also want to point out chipmaker Intel, they're down about 7% right now. So not looking good. We'll have more coming up in just a bit.
All right, Lisa Mateo, thank you so much. We appreciate it. Alix Steel, she's in for Tom Keene. What a day to take off for Mr. Tom Keene.
I know.
But Alix Steel here.
And he hasn't even written in. He hasn't called in, written in, nothing.
Nothing. I mean, he's taking a surveillance nap a little early today, maybe. So we'll have to, he'll be back tomorrow. But we're here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. We're in your dashboard with Apple CarPlay, Android Auto, all that technology stuff. The radio geeks here figured out at Bloomberg. So we're everywhere, basically.
Everywhere. You can't escape us.
Yeah. Let's go to Joanne Bianco. She joins us. She's a partner at Bond Blocks. So, Joanne, here you're in the ETF business. You focus on the bond market, giving your investors really lots of opportunities to invest in the bond market. What do you make in the moves we've seen in the bond market over the past couple of days?
Well, I think it's extreme to go right to the word recession. We may very well be transitioning to slower growth, and I'm not saying that the path to slower growth couldn't have bumps or risk, but basically too much Fed easing too fast could have risks too. So the big move that we've seen in the past week has brought rates back below last year's year-end lows. So this actually already serves as a loosening of financial market conditions.
So what does that then mean? So in some weird way, the sell-off, well, I guess the rally in the bond market is loosening financial conditions, but then the sell-off in the equity market winds up hurting it. So where does that leave us?
Where it leaves us is that, as long as it's not something that significantly causes consumers to retrench or businesses to retrench, this could be just a bump in the road for the markets and actually set up better buying opportunities.
So, Joanne, what do you think the Fed is going to do here? I think most people were saying, September seems really, really likely for, some type of cut here. Now the question's about maybe an emergency move on rates, maybe even, I guess, some people on the sell side. I think Goldman's calling for 250 basis point cuts this year. How do you think this Federal Reserve will react to some of the recent market activity and data?
Well, they've been very measured in their approach, and we expect them to remain measured in their approach. So I think there's, anything can happen. They could decide to go 50. I think that most likely our view right now is that they will start by cutting rates by 25 basis points in September, and then just can see where we are. We still have a few more rounds of inflation and jobs data, and that's going to be pivotal going into the Fed's decision to start cutting rates. So it's time will tell. And I think they're not going to overreact to 1 month of data.
No, they're not, and Goolsbee has definitely had a lot of opportunity over the last few days to say something. He would talk to us on Friday. He talked to CNBC this morning, and he definitely shied away from that. In the ETF market, if I'm an investor and I want safety, what do I do?
You could be on the short end in treasuries. We have products there. We have 8 treasury ETFs along the curve, starting with 6 months out to 20 years. You could also be in BBB corporates. We have BBB corporate products too that are broken down by maturity. And so if you focused on the 1 to 5 year BBB part of the market, BBBS is the ticker, or the 5 to 10 year part of the market, BBBI, you could take advantage of still resilient fundamentals for especially for investment grade rated corporations and BBBs. And then also take advantage if you do lengthen to focus on the intermediate part of the curve for any kind of total return tailwind from lowering rates.
So, Joanne, we had kind of the inverted yield curve kind of disinvert, if you will, earlier this morning with the 2 years and the 10 years kind of trading within the same general area. It's now about a 5-point inversion right now. Well, what did that mean to you, if anything?
I think it didn't mean all that much. It hasn't meant all that much since 2022. So it has not, the recession has not followed yet. So, I mean, it's obviously something that we always continue to watch to determine any kind of predictive power that it has. But so far, it hasn't done what it's done in the past.
Fair enough. And, if that was the case, then that recession indicator of inversion would have been highlighting recession for a while. When we talk about sort of where you go for safety in the ETF market, are we seeing a lot of flows, say, out of tech, for example, or out of those high-flying winners, or is it not that simple?
Well, in fixed income, it's not the same kind of, you don't have the same kind of risk. Where you have more risk in technology would be on the high yield side. Okay. And that's been kind of a laggard in performance in high yield, although it did have a good month in July.
Joanne, thank you so much for joining us. Really appreciate it. Joanne Bianco, partner at Bond Blocks ETF provider, focusing on fixed income there. Looking at these markets here, S&P 500 off 3.3%. That's 178 points. The Dow off 2.7%. That's 1,070 points. Gets your attention. And NASDAQ leading the way down 4.3%, 725 points. 16,050 for your NASDAQ. Looking at the yield space, 10-year Treasury, that's off about 6.5 basis points, 3.72%. The 2 years, 3.78%. So we'll keep an eye on that. WTI crude oil off a little bit here, just below $73 per barrel. Let's check in with our good friend Molly Smith. She is editor for Bloomberg Economics for Bloomberg News. She is joining us via Zoom here. Molly, it seems like the economic outlook went from Thursday soft landing discussion to today. I don't know what's going on. Maybe we got a recession like right around the corner. What's changed from the economic perspective just in the last several days, Molly?
I mean, it obviously, of course, has all been around this jobs report that we got on Friday, which came in weaker than forecast on pretty much all fronts. But I think it's hard to really say that the outlook has really significantly changed as much as the reaction in markets would suggest. I think this is a lot of, it looks to be more like overselling and very reactive, kind of like what Chicago Fed President Austin Goolsbee has been saying in the last couple of days, that this is very much like that the Fed is not here to overreact the way that markets often do. The Fed is reactive, markets may be overreactive. So he's trying to maybe quell a little bit of concern here, but certainly that jobs report does maybe make us think that the outlook is weaker than it already was, but I don't know if it's as weak as what markets are suggesting.
Right. So the market, obviously not the economy. We said that a lot. The stock market is not the economy. However, there is a narrative of that Fed put. And I'm wondering what kind of market action do we have to see that warrants the resurgence of a Fed put, or if that's just done for now?
Well, here's the thing, is that the Fed wants to react to changes in the real economy. They don't want to be reacting to financial conditions, tightening or loosening. Of course, they're mindful of that, and this certainly plays into how effective their policy is, but that doesn't mean that this is something that they're going to see a massive sell-off in the stock market and treasuries and think, oh my gosh, we need to start moving now, or really materially change our outlook. So for now, I think, of course, as Powell said last week, September cut seems to be the likely base case. It's, I think, more a matter of how much at the moment, not a discussion of a preemptive cut before the September meeting. I think that would probably do more bad than good.
So, Molly, what are we seeing from some of the economists, our good friends on Wall Street? What are they saying about this Fed? And should it go early? Should it go maybe just heavy, but go heavy during the scheduled meetings later on this year? What are we hearing from them?
Yeah, the recalculation of Fed bets after the jobs report on Friday. I mean, I was personally a bit surprised by just how much people started shifting. That it seems now like the base case for several Wall Street banks, at least JP Morgan and Citi among them, is for 2 50 basis point cuts, each coming in September and November, followed by another quarter point in December and quarter points thereafter into 2025. That's a massive change from what we saw before the jobs report, which was kind of still maybe thinking 225 basis point cuts for the totality of 2024. So now we've really recalibrated massively. And but look, there's still a lot of time between now and September. There's roughly 6 weeks till that meeting. So I don't know. It could very much reach it. It could very much change again.
Yeah, absolutely. And this has just been 2 days of this. So we'll see. Molly Smith, thank you so much. U.S. economy editor for Bloomberg News. We really appreciate that. Just your data check here. S&P 500 off by 3%. The NASDAQ off by almost 4%. Let's get more here for Business Flash with Lisa Mateo. Lisa?
Yeah, those fears definitely of economic slowdown sparking that sell-off. So let's break down the specifics. So you have the NASDAQ down about 3%. That's 637 points, 16,138. We have the S&P 500 down 3%, 163 points, 5,182. The Dow down nearly 2.5%, 992 points, 38,741. We have the 2-year yield at 3.79%. That's down 9 basis points. We have the 10-year yield at 3.73%, and that's down 6 basis points. Tech really been taking a hit of the Magnificent Seven. The biggest decliners, NVIDIA right now down 8%. We have Tesla down nearly 5.5%. Bitcoin also taking a hit, down 11%, 52,185. Taking a look at crypto-linked companies like Coinbase Global, down 11%. Marathon Digital down 11%. We have MicroStrategy down 17%. Now, in the midst of all the bad news, there are some companies that are seeing a lift. I don't want to be a Debbie Downer. So one of those, snack maker Kellanova, up about 16%. Mars is considering buying the company. That's behind Pringles, Cheez-Its, and Paul's childhood favorite Pop-Tarts.
Yes.
That is your Bloomberg Business Flash. Paul and Alex.
Now we're talking. You pop a couple of those in the toaster, good to go. That'll get you through the day, no problem at all.
Or like the first hour, but go
exactly,
ahead.
Exactly. All right, let's check in with somebody who I guess he's got something to say we want to hear about. Do you think?
I think so.
Ira Jersey. He's our U.S. interest rate strategist for Bloomberg Intelligence. He is the go-to voice on what's happening in the Treasury market. Hey, Ira, that curve was like uninverted for about a cup of coffee earlier this morning. It means nothing to me, but I think to you people it means something, doesn't it?
So you must drink your coffee fast because it really wasn't very long at all. So the curve being uninverted at this point, it's not a signal of anything. It's more just the market repricing the front end of the yield curve. So this morning, and we bounced back pretty dramatically from these levels, but at one point this morning you had 2-year yields lower by 20 basis points, and what the market was doing was pricing in an even lower terminal rate than was originally expected. So basically the Federal Reserve cutting faster and also cutting to a lower level than it had thought before. So 2-year yields were significantly lower than 10-year yields were, and that's why you had that uninversion of the curve. I think we're going to get there, right? It's just a matter of how quickly and how what the path is to get to a normal shaped yield curve. It just might not happen today, but it's going to happen over the next couple of months, or at least by the end of the year, we think.
I just do want to point out from what you just said, Ira, yes, at one point, like an hour ago, we were down like 22 basis points in the 2-year. We're now only down 8. S&P's only off 3%. I mean, if you look at a chart of the cash market, it's just a straight line up at this point, even though we're still negative. It feels like it's just so interesting because I wonder if we're going to turn around throughout the trading day. Ira, what do you think? Is this just an overdone reaction that we're going to kind of come back to normal?
So I think one of the reasons that we had such a dramatic move kind of overnight and in the early morning hours is just, basically Asia and Europe coming in and reacting to what happened in the U.S. on Friday. And you wound up with a situation, too, overnight, in particular, where liquidity was pretty bad because you have some markets that are actually closed today as a national holiday. So I think once that reaction was over, you then had, the U.S. equity market open. You have, certain algorithms and the like that are saying, oh, maybe things are a bit oversold, so we're overbought in the case of treasuries. So why don't we come in and step in and go the other way? But still, 3% lower on equities is certainly something that's going to be in the eyes of a lot of bond traders. And I think that the Treasury market is going to take its cues primarily over the near term from what's going on in risk asset markets. So things like oil is going to be a key, and as well as equities. And all of these markets have been highly correlated today. So in the case of treasuries, treasury yields have been correlated with rates and with the direction of oil on the day. And I don't see any reason why that would stop. We have, some data that's going to come out in a couple of minutes. I don't think it's going to have a massive effect on the markets, but we do have supply this week. So, the 3-year note tomorrow, 10-year note Wednesday, and 30 years on Thursday, those will be the three kind of maybe impetuses for something to happen in the Treasury market. Otherwise, we're going to wait till next week's inflation and retail sales data before probably getting any kind of trend move.
All right, Ira, thank you so much for joining us. Really appreciate you hopping on here on a very day of big movements across the financial markets. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. All right, NVIDIA, Alex, opened today at 92. It's now trading at 99. So, it's one of those things. If you had bought some of the stock on the open, it seems to be a little bit of a bounce here in the cash market just here in the first half hour or so we're trading, but definitely still significant red across the screen here.
Yeah. I have to wonder because the systemic funds, they don't trade pre-market, but a lot of analysts are talking about the fact that they're still pointing towards more selling. I'm talking like the vol funds, I'm talking like CTAs, that either way that points to more selling, but I wonder if that's part of kind of the change that we're going to wind up seeing. I don't know. We have a long way to go until the end of the trading day.
Long way
that's
to go.
For sure.
And I'll be here for a lot of it.
Yeah, you have a long way to go too. I'm leaving because I got to do TV in the afternoon.
Oh, man.
I know. I keep telling them I'll stay, and they keep being nice to me. I don't know what that's about.
You're a TV star, so that's okay.
But Jess Menton is coming to help you
out.
out.
Oh, that's good. All right,
yeah.
she'll help out here, so that'll be good. All right, looking at these markets here again, we have red across the screen. S&P off 3.2%. The Nasdaq off even 4% here. So some big moves out there. Yield curve moving, but as Alex said, bouncing here. We have the 10-year yield off 7 basis points, 3.71%. WTI crude oil off about 75 cents, just under $73 per barrel. Gold off $50, $23.92, and Bitcoin off 12%, 52,000. We were at 50,000 just earlier. A lot more coming up. This is Bloomberg.